the corporate sector is doing great.
It's all about earnings.
The headline on 2026 is the noise continues to be noisier and ratcheted up.
I think investors, to be fair, are keeping their eye on the ball.
There has been a lot happening in the face of what has been largely a resilient equity market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, the equity market rally broadens. Small caps beating the S&P 500 for 10 consecutive sessions as President Trump is pushing for tech companies to fund new power plants, and Federal Reserve officials are lining up to hit pause on rate cuts one day before the Fed goes silent.
And it makes sense given what we've seen in terms of the data, especially the economic data. Look at the jobless claims yesterday. The Fed has cut rates at each of the final 3 meetings of 2026. And now there's this inclination that maybe it's time to stop, take a breath, and hit pause for a bit. That's what I heard with New York Fed President John Williams earlier in the week. He was speaking on Council of Foreign Relations. I was there, Jonathan, in the audience, and there wasn't a sense of urgency that he felt the Fed needed to act.
You've seen that echoed on Wall Street this week. Mike Ferroli over at JP Morgan, no rate cuts this year. We'll catch up with Stephen Stanley of Santander, also in the camp of no rate cuts this year. And Morgan Stanley's Mike Apin saying this about consumption. The data's better. He says consumption is overshooting. He expects it to continue.
That's what a lot of people are saying, that the consumer is resilient right now. We heard that on all the bank calls this week as well, coming from Bank of America and other C-suite executives, as well as what you see from the individuals like Torsten Slok. This potential tailwind risk of 2026 overheating. You have the one big beautiful bill, huge fiscal impulse because we're heading into a midterm election.
You mentioned the banks. Let's talk about the banks. So the performance this week has been pretty interesting. JP Morgan this week down by something like 6%. Then you've got the likes of Goldman up by around about 4%. Two very different stories. What gives? Plenty of explanations. Here's one. One has got exposure to credit cards and the president's going after them, and the other one does not at all.
It was all about policies out of Washington, even for the banks that did so well. Some of that trading has to do with volatility, getting deals over the finish line, has to do with deregulatory push, how a lot of people were on the sidelines during the Biden administration and were so excited for Trump to come in for M&A and IPOs. But if you have a credit card, now you have a target on your back from this administration. The president is not backing down. Who knows what we get? Potentially some sort of swipe fee competition bill gets through. Maybe a cap, not as high as 10%, according to people I'm thinking of. But if you have a credit card, this is now a risk for this year before the midterm elections in November.
This is the populist spark into the midterms. Let's see what the bite actually looks like. It's not just the financials, it's tech as well. We open up the program by talking about energy, and it's not just the president going after these names. Governor Kathy Hochul here in New York doing almost exactly the same thing, pushing for the energy companies to either generate their own electricity or pay more for the stuff they're taking from the grid.
Basically, what the president is saying is you tech companies need to either become utility companies or subsidize the U.S. consumer because these rates are too high. And we saw this story play out in Virginia and New Jersey when it comes to those governor races. Individuals that were talking about the electricity prices are too high, those individuals did very well at the polls. This is interesting because the president is not just going to be flanked by Governor Glenn Youngkin, a Republican in Virginia, which has a lot of data centers. Josh Shapiro of Pennsylvania will also be there at the White House. You see this olive branch to the left, to the Democrats, from this president. And you know what, Jonathan? A lot of these issues should be dealt with on a state level. Trump is taking it to the federal level.
We're going to see more of this in the year to come, no doubt. In fact, the years to come. If you are just joining us, welcome to the program. Equity futures this morning positive by about 1/3 on the S&P 500. Coming up this hour, we'll catch up with Eric Friedman of Northern Trust with stocks near record highs. Dana Peterson of the Conference Board on the issues keeping C-suites up at night. And Eric Najarian of UBS wrapping up big bank earnings on Wall Street. We begin this hour with stocks rising on a fresh round of momentum across the equity market. Eric Friedman of Northern Trust writing, we remain constructive on traditionally riskier asset classes. We expect stocks to continue to outperform bonds. Eric joins us now for more. Eric, 1, congratulations on the new seat. 2, welcome to the program. And 3, the first question, sir. It's good to see you. Let's just get into it. What underpins that view that's pushing stocks to outperform, say, bonds?
Jonathan, congratulations to you as well. I think first and foremost, we still think that this notion of consensus being still too bearish on growth and probably too overzealous on inflation, a theme that we talked about throughout 2025, we think continues. And Annmarie, I think, nailed it with some of her comments about the banks that we've heard from thus far. I think, number one, consumers at the margin are not outperforming massively, but they're really hanging in there. We've seen a very promotional environment. We've seen a lot of discounting, but that being said, consumers are still very involved in terms of day-to-day purchases. Also, corporations, not just in the US, but globally, they've really recalibrated, Jonathan, in terms of thinking about trades and tariffs and what may happen headline by headline. In general, that recalibration, I think your colleague Tom Keene would say the adjustment process is really fully underway. So those are still two tailwinds until we're proven wrong. Again, we have to respect the fact that we pulled forward so much in terms of earnings, so much in terms of returns, that we don't think this year will necessarily be a continuation of the last three, but still incrementally positive on stocks over bonds.
It is a midterm year. Eric, I was going through your note, an interesting read, and you said this: in a midterm election year, it keeps the risk-on bias intact. Is there something different about this populist twist that might upset the traditional story?
I think the biggest risk, Jonathan, is that the Fed loses the 10-year. And when I say that, I think, you've all done a great job of reporting on the various policy sets that may come forth. There's certainly a shift in voters' minds about what really their priorities are. And a lot of it focuses on the economy and inflation. And one of the things that we obviously enjoy about our line of work is that markets don't really care about narratives. They care about perceived policy impacts to, things like getting paid back. So there have been a couple instances in history, not to go back to history books, where the Fed has lost a 10-year. And for us, that would signify a 10-year, north of 475 or 5. Pretty far from where we are right now, but that could probably upset the narrative, if you will, Jonathan, that, all these policies have to be ultimately paid for. For a long time, the bond market has kind of shrugged them off. But in aggregate, if there's too much, we think that risk of the 475 to 5% 10-year yield challenge, that could be something that becomes more front and center.
You might be giving the Treasury Secretary a heart attack this morning, Eric. What kind of policies exactly from Washington could put the 10-year yield north of 4.5%?
I think the biggest, Annmarie, would be an overextension of let's call it tax, or perhaps more episodic stimulus that eventually just aggregates to a point. Everything from a lot of the considerations around tips, taxes on tips, or even some what's called state level stimulus, if you will, that pops in. I do think that ultimately, and again, we have this IEEPA ruling hanging over our heads. That outcome is obviously an uncertain one, but if we do have some concerns from the bond market about pay-fors, as well as an increased level of stimulus coming through that is not fully paid for, those are items that eventually, let's call it the St. Bernard that is the market, that lots of things tug on its fur, may say, okay, we've had enough. We're going to test the resolve of this administration. That's where investors could get concerned. That 4.5, 475 level becomes much more relevant.
A lot of guests had come on this program and said, look through the Supreme Court, because even if they do strike down IEEPA, the president is going to use other legal justifications for his tariffs. Do you think that it really is a market-moving event?
Annmarie, you individually have done a great job, almost encyclopedic, about the other sections that the administration could use. Where there's a will, there's a way. That's our thought process. We're obviously not trade experts day to day or trade law experts, but there is a clear bias from this administration. Everything from cheering a CPI report and other factors, with quoting the tariff regime as being at least a causal agent in helping things out. So where there is a will, there is a way. So we do think that, again, the reaction will probably just be that, a reaction. But again, our thought is that the tariff regime will continue, probably just under some different section of the law.
Eric, the stock market's moved on, as you well know. The equal weight S&P 500, all-time high, 6 days of gains. The Russell, we talked about at the top of the hour, outperformed the S&P for 10 consecutive sessions. Eric, a lot of people have been waiting for this, and they see these moments where you get these rotations, but they don't last too long. Has something changed?
Yeah, Jonathan, we do think something has changed. I think that the broadening out trade has been very well documented. I mean, the way that we're playing this is that we really don't want to be underweight tech. We really don't want to be underweight some of those picks and shovel companies that we've all talked about for some time. And again, part of our overweight stance towards equities is that we want to have at least equal weight exposure to tech and infrastructure, and then a little bit of the other things that haven't really caught up. Again, I think the pull forward, though, of returns, just the things we've been talking to our clients about, is that, look, we've compounded in the S&P over the last 3 years at 23%. EFA 18%, EM 17%. Those are big numbers. So that pull forward is something we have to respect. We do think that broadening out is a good thing, but again, have a little more subdued expectations for returns for this year. That's probably the right posturing to think about as we turn the page.
Eric, can we just sit on smalls just for a moment? Initially, when this trade ignited, it was about rates. The rate cut story is really stalled now. Rates themselves have stabilized. What's it about now?
Yeah, I think it's about a catch-up, Jonathan. I mean, a couple of things about the Russell Index. You think about the quality factor, about 25% of the Russell 2000 does actually not have profits. So, there is a bit of a momentum, called lower quality bias there. Also, there's a large bias towards financials, which people don't really think about, and obviously financial related entities. And one of the things to keep in mind is that the 10-year to Fed funds spread is actually at its widest it's been in about a year. It's kind of in line with where it's been over the last 5 years, but over the more recent time period, that steepening, if you will, between Fed funds and the 10-year, that does bode well for that set, and certainly has been a tailwind for the Russell 2000.
The 10-year this morning, 4.17. Eric, good to see you, sir. Eric Friedman there of Northern Trust. Thank you for joining us. Small caps so far this year, a couple of weeks into a new year. The Russell is up by close to 8%. To be precise, up by 7.76% so far in 2026. That is quite a run. That's the stock market. Let's give you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Good morning. President Trump and the governors of several northeastern states agreeing to push for an emergency wholesale electricity auction that would compel technology companies to effectively fund new power plants. The plan, set to be announced this morning, seeks to address how the nation can supply electricity to data centers without hiking utility bills for homes and businesses. Iran averting a U.S. strike by pledging not to execute protesters. In a post on Truth Social, President Donald Trump writing, Iran's decision not to sentence protesters to death is good news. Iran's judiciary on Wednesday ruled out a death sentence for a 26-year-old activist who it said was at risk of imminent execution. The U.S. and Taiwan agreeing to a trade pact that would lower tariffs on goods from the island to 15%. In return, Taiwanese semiconductor companies will increase financing for their American operations by $500 billion. That includes at least $250 billion in direct investments to expand semiconductor, energy, and AI facilities. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later on this hour. Up next on the programme, pushing big tech to pick up the tab.
Every company will be given the right to build their own power plant. We'll use every tool at our disposal to ensure that the United States can build and maintain the largest, most powerful, and most advanced AI infrastructure anywhere on the planet.
That conversation up next with John Lieber of Eurasia Group, live from New York City this morning. Good morning. Things are a little quieter stateside going into the long weekend. Things might get noisy next week. Check it out. The President, Wednesday. This is the main event next week and could well be market moving given the experience of the year so far. The President addressing the World Economic Forum on Wednesday morning.
So if you are one of these individuals that he thinks you're a globalist elite, you potentially might get called out when the president gives his speech at the World Economic Forum. But we also know that in this push for affordability he's had domestically, he's going to talk about that on this stage in front of everyone around the world. Caroline Levitt talking about how he wants to talk about housing while he's there. So whatever his message is internationally, there will be some thread back to the U.S.
This year so far, defense sector, whipsawed. Home builders, you mentioned them, whipsawed. Credit card issuers, whipsawed. What's in store on Wednesday? What other sectors? The tech players, energy? I don't know at this point.
Well, the tech sector has already been whipsawed in a sense. We've already heard from Microsoft saying we are going to make sure that we are putting up more of the money for the electricity. And Gil Luria is quoted as saying this might actually start to hit some of the tech players' margins because the president is basically asking, the crux of this is, you have to subsidize American consumers' electricity bills.
That's the story for next week. This morning, equity futures still just about positive, up by 1/3 on the S&P 500. On the Nasdaq, up by 0.6. The big winner of the year so far, the Russell. Small caps higher by 0.4%. Under surveillance this morning, pushing big tech to pick up the tab.
Every company will be given the right to build their own power plant. So when you build, you can build your power plant with it. And you are essentially going to become your own utility. Any excess energy you're going to sell back to the grid and make plenty of money doing it. We'll use every tool at our disposal to ensure that the United States can build and maintain the largest, most powerful, and most advanced AI infrastructure anywhere on the planet.
So here's the latest this morning. President Trump pushing for tech companies to foot the bill for new plants to power AI data centers. Sources telling us here at Bloomberg the move would fund some $15 billion of new plants to take pressure off of homes and businesses. Joining us now from Washington is Bloomberg's Tyler Kendall. Tyler, the big push, the latest big push of the last 24 hours.
Yeah. Hey, John. Good morning. I mean, this is considered to be an unprecedented move aimed at easing concerns that data centers are driving up electricity costs amid the AI boom and the fact that this White House is playing defense when it comes to affordability. Now, a White House official tells Bloomberg News that President Trump, alongside a number of governors whose states are served by the nation's largest power grid, PJM, will call for an emergency wholesale energy auction where essentially big tech companies would place bids to fund new power plants. And we are talking about, just for context here, unique and one-time terms. Typically, PJM holds electricity auctions for a 12-month period. But instead, this plan is putting forth the idea of 15-year contracts where the only bidders are data center owners and operators. Now, this grid in particular, which serves 13 states, has been strained by more data centers coming online and actually more power plants going offline faster than they can be replaced, which has put a squeeze on supplies. And as you heard there, President Trump has previously floated this idea that he likes that data centers could be built alongside power plants. And we sort of heard him tease that this announcement was going to be coming earlier this week when he took to Truth Social. And he said that he was working to ensure that big tech doesn't drive up prices and praised, as Annmarie mentioned at the top of the segment, a pledge by Microsoft to pay more of its, quote, fair share. Now, our reporting indicates that this is going to be a non-binding directive, which means that PJM doesn't necessarily need to go along with it. So it might not come to fruition, though there is definitely mounting pressure. John, expected at the White House today is Democratic Governor of Pennsylvania, Josh Shapiro. I actually sat down with him back in September, and at the time, he told me he was threatening to pull his state out of PJM if the grid operator didn't do more to rein in costs. I would expect some similar threats could be on the table today.
Tyler Kendall with the latest down in Washington. Tyler, thank you. To extend the conversation, John Lieber of Eurasia Group joins us now. John, you heard it there from Tyler. Annmarie mentioned it as well. Governor Shapiro at the White House. Is this just a new political reality that both parties have to confront?
Yeah, I mean, I think actually President Trump's trying to get out ahead of the curve here. We know affordability is probably the number one issue on voters' minds for 2026. And this electricity issue was a factor in some of the off-cycle elections that we saw in New Jersey and Virginia last year. So, you know, the data centers, it's a big deal. It's a big part of Trump's industrial strategy. They want the U.S. to be the world leader in AI. And to be the world leader in AI, you need to consume a lot of energy. And that's going to become an increasing political problem for people all over the country. I do think, to your point, it's notable that Democrats are willing to play ball here with the administration. This reflects the power that only the White House has. And I think that this is going to be an ongoing theme that we see throughout the year.
Not just Democratic governors willing to play ball, tech companies, Microsoft, Brad Smith, we're going to ask utilities and public commissions to set our rates high enough to cover electricity costs for our data centers. John, is this just another implementation of state capitalism?
Yeah, I think that's exactly one way to think about it. I think Microsoft knows that the Trump administration is their biggest champion. They really need Trump to get the licenses that they need to have access to semiconductors. I mean, the administration has been extraordinarily aggressive in shaping how these tech companies sell chips, buy chips, have access around the globe, and they've been championing them. And I think that Microsoft sees the writing on the wall here, which is that this is a growing political story that they need to get ahead of, exactly the same as how the Trump administration's doing this. And I think this is going to be a big theme for the year. I think that electricity is a vulnerability for the president. And by doing this and by getting their partners like Microsoft to do this, it's an incredibly savvy way of saying he's doing something about the problem.
Not to get too in the weeds, but there is a law from 1935, the Federal Power Act, which basically separates when it comes to the grid how the state's jurisdictions over it, over the federal government. Are we pretty much just resetting new rules of engagement between how the states deal with electricity?
I'm not familiar with the rules of the electrical grid and how it works at the state level, but I do think federal intervention here is probably appropriate. And given that this is multiple states coming together to drive this new initiative and put this new electricity on the market, and it's affecting all these tech companies that are trying to invest everywhere in the United States, this sets a tone for the entire country and tells these tech companies that they're going to need to be partners in solving this problem. And because of that, you're probably going to see more efforts to take advantage of a diverse source of electricity generation, including probably over time nuclear power, which had previously fallen out of favor in the United States. And now that the tech companies need it, is going to be surging back.
John mentioned all of what's going on in terms of the president's latest salvos on Truth Social, the defense sector, housing, credit card companies. What do you expect him to deliver at Davos?
Yeah, it's only been, we're in the third week of the year, and it feels like we've lived 3 years so far, given all the stuff that's going on. Yeah, I think the Davos speech will probably be a chance for Trump, as he does, to air some grievances in front of a crowd that he probably thinks is hostile to him, but he still wants to get in front of. He mentioned housing as one of the things he's going to talk about. I think there's going to be other affordability things brought up. One of the big things on housing is long-term rates. They've been attempting to use Fannie and Freddie in order to get long-term mortgage rates down. I think that probably healthcare is going to be an issue that is in focus in this speech on affordability. There's still the live issue of these Affordable Care Act subsidies that's happening in Congress right now. And then electricity, I think, and energy costs are probably going to be a big piece of it. Not just electricity, but also energy prices. I mean, oil prices. That's one of the primary drivers, or at least it's the primary outcome of this Venezuela interdiction, is that they're putting all these new barrels of oil on the market. And I think that keeping energy costs low is going to be a big theme.
John, is there a home for people who support traditional conservative policy?
In the United States, I mean, no. You've got the Republican Party is, or at least under Trump, is massively interventionist, and there are a lot of Republicans, many of whom have only been elected in the Trump era. I mean, over the half of the House of Representatives came into office after Trump was already here, and have helped him totally reshape this party into a much more populist, much more aggressive, much more interventionist party that seems to have no limits to the kind of things that they're going to do to deliver benefits for voters. So I think the era of small government is really over here. And, you're going to see a government that's on both sides that's now reacting to the need for voters to want to see change in their life. And so I think both parties now are going to be much, much more aggressive in how they try to do that.
How much daylight do you think there'll be between the two parties on economic policy by the time we get to 28?
Very little. Probably tax policy will be the big one. There will probably be more lip service paid to the deficit from the Republicans. Democrats will probably support a more larger tax increases in order to bring down the deficit. I think on trade, you're going to see a lot of similarities. Labor policy is probably another one where you see a big difference, but more divergence in the coming years. So, I think the parties are going to compete on cultural differences. Immigration will probably be a big wedge issue in the upcoming election. But on economic policy, these parties are looking more and more similar to each other.
John, appreciate it. John Lieber, of your Asia Group. Thank you, sir. Notice this on the campaign trail. Do you remember the president would come up with an idea on the campaign trail, and then Kamala Harris would come out with it the next day? Do you remember? It was like that, and now you see the same thing this time around.
And people didn't think no tax on tips could get through. So those individuals, I'm reminding them, that actually did happen when you're concerned about the credit card interest rate caps. It might not be exactly. Remember, the president, Jonathan, you remind us all the time, anchors the debate to the extreme. So maybe it's not going to be 10%. But if he says something, he's going to push for it. So expect more of this as we head into November and then 2028. My mind hasn't even gotten there yet.
Stock market's looking right through it. Earnings are good. Equities are up. We're up by another third of 1% this morning on the S&P 500. Up next, we'll talk about CEO confidence with Dana Peterson of the Conference Board. Live from New York City, welcome to the program. A cold start to this Friday morning, going into the long weekend. here in New York City. Very, very cold. Equity futures right now in the S&P 500 positive. Warming up, we're up by 1/3%. On the Nasdaq, up by 0.6. Struggling to put together back-to-back weekly gains on the S&P. Let's see if we can change that later on this morning. It has not been a struggle for the equal weight. The equal weight S&P 500 positive for 6 consecutive days and 10 straight sessions of Russell outperformance versus the S&P 500. Jim Reed at Deutsche Bank pointing out we haven't seen that since 1990. Russell futures up by 0.4%. Turn to the bond market. What a snooze. A welcome snooze for the Treasury Secretary. This is what they want to see. Stability in the bond market. It's what we've got. 417.15 on a 10-year. Last Friday we closed at 416. And since this morning we're again at 417. That's the story of the bond market.
But Eric Friedman's talking about potential risks this year and going into the midterm elections. Too much of fiscal impulse. You have the bond market really pushed back, especially also what if the IEEPA tariffs are deemed illegal? The bond market has looked at that and said, look, we're maybe able to potentially bring the deficit down with more money coming in. That would not bode well for this administration.
Dead flat treasuries, front end, long end, really sleepy stuff through the week so far. Turn to foreign exchange. This is a quiet rally. The dollar index, DXY, and this is euro dollar showing a bit of euro strength, but DXY quietly putting together 3 consecutive weeks of strength. And if we do that, we close this Friday for another week of strength. That's the longest run going back to May of last year. So there you go. Bit of dollar weakness this morning, euro positive to 116.19. As we count you down to the opening bell, let's get you some morning movers, some single names. Let's cross over to Danny for more. Hey, Danny.
John, I'm going to show you where the real strength is in this market, and it is memory chip stocks. These things continue to fly. Look at the pre-market session for SanDisk and Micron. Those shares are up at least 5.5%. SanDisk this year is up something like 70%. Micron not as impressive, but still in the high teens. No specific news, but it's the continued momentum underscored by TSMC yesterday that there is so much demand for AI, and that is translating into demand for memory. But there's a bad side to that. It is for any of the hardware providers, hardware makers that also need memory chips. HP is one of them. They received a downgrade this morning from CFRA saying, 1, the company has very anemic growth, and 2, its costs are going to start soaring because of what's happening in memory chips. Those shares are down 2.6%. Rounding things out this morning with some earnings, we got the trucker company J.B. Hunt reporting yesterday. It was a miss across the board. It is continued weakness for the freight industry. For one, they have an oversupply and not enough demand. And you saw in J.B. Hunt's earnings that transcontinental shipping, it is down massively. Basically, the only growth they saw was within the United States, within the U.S. East. So those shares falling 5.4% in the pre-market, John.
Danny, thanks for the update. Appreciate it. More from Danny in the next hour. On our radar this morning, President Donald Trump pushing tech giants to foot the bill for new power plants. Sources telling us here at Bloomberg the plan will require companies to sign 15-year contracts for electricity, whether they use the energy or not. Elsewhere, the US and Taiwan reaching a trade pact, slashing tariffs on Taiwanese goods to 15%. In exchange, Taiwan investing $500 billion into American semiconductor manufacturing and financing guarantees. And your final story, a controversial one. Ford, reportedly in talks with China's BYD about supplying batteries for hybrid vehicles at its overseas factories. Sources telling us here at Bloomberg those hybrids would be exported worldwide, a move that's already sparking political backlash in D.C.
From the White House, from Peter Navarro, he was quick on X to talk about saying Ford wants to simultaneously prop up a Chinese competitor supply chain and make it more vulnerable to that same supply chain extortion. What could go wrong here? Those are the words from Peter Navarro. Ford is looking at this like, look, we already use BYD batteries when it comes to our vehicles in China. And I remember the commodity guys years ago said to me, you're too focused, Annmarie, on the raw materials. Think about what China's long-term play is. They are the only ones that have the raw materials and the processing power, 80-90% of the market, to actually make that battery. At some point, China is going to say, you want electric vehicles? Buy our cars. That's the entire long-term play. And you can see Beijing being absolutely propped up by this, and this could be the baby steps going towards that direction.
There's a big negotiation coming up, USMCA. And I wonder, Annmarie, the direction of travel here, because really when you think about USMCA, the industry most exposed to that, just one, auto manufacturers, Ford, GM, Stellantis. It's going to be a big feature of the conversation through the next year.
Especially as the Prime Minister of Canada, Mark Carney, this morning posts a photo on Twitter of him and Xi Jinping, talks about this new strategic partnership.
New world order.
With China.
To use the Prime Minister's exact, precise language.
Yeah, and a new strategic partnership when it comes to trade and other things when it comes to China. Do you see countries that are close to the United States that should be working more interlinked with the United States actually looking to maybe go to China because it's cheaper products, and right now the rhetoric coming out of Washington isn't helpful for them?
Ford this morning in the pre-market, positive by 0.1%. Let's turn back to markets. Earnings season off to a strong start as investors position for the year ahead. Dana Peterson and their team at the conference board releasing their 2026 C-suite survey, identifying the top issues keeping CEOs up at night. Dana joins us now for more. Dana, welcome to the programme. Share what you found. Number one last year had to have been tariffs, and we moved on from that pretty quickly. Is it still tariffs, or have things changed?
The new word is uncertainty. Businesses are just not sure, certainly about tariffs, but also geopolitics, regulation, and many of them see AI as a very disruptive force, either for good or for bad. And so with all those things, CEOs are just very worried, and they are trying to figure out ways to kind of cut through the fog so that they can remain profitable.
Dana, by definition, the future is always uncertain. What is unique about this? And are they experiencing a form of paralysis, or are they actually making decisions and moving forward?
Well, if you go back to 2024, there was a lot of excitement. Businesses were anticipating deregulation. They were anticipating lower taxes in the U.S. However, all of last year was just really wild in terms of changes in policy. Though you did have tax cuts and also acceleration of depreciation for writing that off, you also had rescissions in industrial policies, and many industries are very much dependent on that, especially those who are looking to onshore. And now that money is gone. And so coming into this year, you have this kind of doubling down in geopolitical issues, not only linked to trade, but also linked to energy. And as mentioned earlier, affordability is a huge issue for many consumers in the U.S. And also businesses want certainty. And so we are seeing businesses just kind of stuck, waiting around to see where things fall. And that certainly is a drag on the economy.
So what do they do with this information, Dana? If this is how they feel, they're concerned about geopolitics, governance, market dynamics. If you're a corporate executive, how do you weather 2026?
Well, the big theme is business plan changes. That could mean small tweaks, just kind of editing things, or it could just mean ripping up the old plan and just starting anew. And many companies are realizing that they need to pivot. There are these major structural and social geopolitical changes that they have to wade through. And they see sitting down and making sure their financials are sound, their governance and risk apparatuses are sound, but also that they're investing in their people. They're investing in their operations. They're investing in new areas. Very much investing in customer service. And they also see AI and training their people as key elements of this transformation.
Do they also think that AI not just could train their people, but also mean that they could reduce their workforce?
Well, I think it really depends on the industry. So certainly the tech sector is looking at AI as a form of automation and also cost savings by having fewer people doing things that computers can do. But there are many other sectors that actually need human beings, like healthcare, construction. And so I think it's, for many businesses, it's, okay, how do we use AI to, facilitate productivity and growth? But you still have that people element. And indeed, CEOs are looking very much to invest in their own people to make sure that they are ready to deploy AI.
Dana, just to build on that, when you look at C-suite confidence, how does it compare to, say, consumer confidence?
Well, consumer confidence, according to our measure, has been slipping over the last year. Consumers are not very pleased with the current situation. Certainly, prices are still elevated. They're still very uncertain about what's going to happen. They're worried about future job prospects as well as their own incomes and finances. So all of those things are very disconcerting for consumers. The key is, does that show up in spending? And we do see that consumers are spending more on necessary goods and services like food, utilities, housing. And even if they want to go out and have fun, they're streaming instead of going to the movies, which is much more expensive. So consumers still are spending. They're just shifting their priorities in terms of what they are buying.
Dana, always appreciate catching up with you. Thanks for sharing the study with us. Dana Peterson there at the Conference Board on consumer confidence and C-suite confidence into 26.
How she ended there and what consumers are having to shift some of their priorities, spending more on food, spending more maybe streaming because you can't afford to go out to the movie theater. I wonder if the White House read this report as well, because they're also going after things like she mentioned, utilities. This is all in the playbook of these populist rhetoric and these populist ideas we've heard from this administration, especially ahead of November, because this is what consumers care about.
They don't need to read this. They just need to look at the polls, and you can see it pretty clearly into the midterms. Equity futures on the S&P positive by 1/3%. With an update on stories worldwide with your Bloomberg Brief, let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. President Trump accepting Venezuelan opposition leader Maria Corina Machado's Nobel Peace Prize medal, saying in a post on Truth Social, "It's a great honor." Machado says she handed it to Trump during their White House meeting as a recognition of his unique commitment to Venezuela's freedom. JP Morgan CEO Jamie Dimon saying there's, quote, absolutely positively no chance he would take the Fed chair job. Speaking to Carlyle's David Rubenstein, Dimon saying he would take the call if considered for Treasury Secretary. Dimon also expressing concerns that chipping away at Fed independence could lead to higher inflation and interest rates over time. TSMC shares trading higher in the pre-market after hitting a record yesterday following its report of a huge fourth quarter profit. CFO Wendell Huang speaking to Bloomberg about the company's future.
In the next 3 years, the total capex is going to be significantly higher than the number in the past 3 years. So that is the evidence of our strong conviction in the AI megatrend.
Wendell also saying TSMC will try to accelerate the transfer of its advanced chip-making expertise to the US in the future. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, big banks setting a high bar.
Their valuations today are very rich. So the high bar that's out there, they met it, but they didn't greatly exceed it like they were doing all of last year.
A conversation up next with Erica Najarian of UBS, live from New York City. You're watching Bloomberg TV. Equity futures this morning positive by 0.25% on the S&P 500, looking to secure another weekly gain on the S&P 500, just short of that as things stand at the close on Thursday. Short of nothing right now on the equal weight. The S&P 500 equal weight at all-time highs at the close on Thursday. 6-day winning streak. The broadening gap continues. The Russell, the small caps, keeps rallying and outperforming the S&P 500 for 10 straight days. The Russell this morning up by 1/3%. In the bond market, really sleepy. We've talked about that as a feature of the year so far. The 2-year in the 350s to end this week like it was just last week. 350, 650 at the front end at the moment. And just a chorus of Fed officials over the last week basically saying the same thing. Policy's in a good place. That was Mary Daly. Raphael Bostic saying inflation's too high. Goolsby saying something similar. Got to get it back to 2%. You were in the room with John Williams, the New York Fed president. Monetary policy is well positioned.
No urgency to move one way or the other. No urgency for cuts. Look, they just came on the heels of 3 meetings where they cut interest rates. And right now, the data isn't flashing a warning that they should be cutting even more. I think that unemployment rate, that's when JP Morgan decided to change their view. 4.4% on the unemployment rate. Nothing scary right now. So what they're calling for is no rate cuts for 2026 and a hike in 2027.
The data's pretty decent. The earnings are too. Under surveillance this morning, big banks setting a high bar.
We think the play for 2026 is financial, so we're still there. You look at the actual numbers at the end of 2025, the upgrade or the increases in estimates were driven by investment banking, trading. The stocks have had a very good year in 2025, and their valuations today are very rich. So the high bar that's out there, they met it, but they didn't greatly exceed it like they were doing all of last year.
So here's the latest this morning. Wall Street's biggest banks reporting a record $134 billion in trading revenue and a major upswing in deal breaking to start the year. Joining us now is Erica Najarian of UBS. Erica, welcome to the program. Strong momentum to close out last year into this year, but a real performance gap opening up this week between the likes of a JP Morgan down and a Goldman Sachs up. Erica, what explains that?
So I think it's pretty simple, right? Valuation aside, what the market is telling us is really that they care more about the pure play exposure to capital markets than they do about valuation. Because if you look at the likes of Morgan Stanley and Goldman Sachs, on an earnings basis, they're not cheaper at all relative to the big money centers like JP Morgan. However, it's a little bit more of a straightforward story rather than the money centers where you have to grapple with, interest income trends relative to the curve. You have to grapple with the credit card rate cap headlines. And so what the market is saying is, wow, we just heard David Solomon say that advisory revenues in 2026 could be better than 2021 in the base case. So why not own cap markets? And by the way, given Morgan Stanley's results, why not own wealth stocks?
Erica, do you think that's the play for 26, those trends to continue?
Look, I think if you already own Goldman, Morgan, and the money center banks, why would you sell them? The momentum is still there in terms of EPS revisions. But what we've been saying is, as we think about new money investments in banks, look, it's going to be a little bit of a tougher climb. So think about what the next sort of leg is in terms of EPS revisions. It might be more like Main Street rather than Wall Street. Small to medium sized enterprises finally expanding. And what I would say is I would look to the regional banks. Additionally, given some of the rate cap headlines, we would also look into some of these beat up consumer finance names that probably didn't deserve to be as beat up as they've been, like Capital One, for example.
Erica, can we talk about the credit card cap interest rate, the probability you and your team think of that, or maybe the competition bill getting through Congress?
Yeah, absolutely. We think it's low probability, extreme outcome, right? And I think that's how the market sort of priced it in on the Monday, the first trading day after that social media post from the president. Look, I mean, you guys, I'm sure you guys pay off your bills every month. Look at the back of your card. Your APR is nowhere close to 10%, right? And so when you do a 10% cap, even if it's just for a year, of course it's going to impact lower income Americans, but it's also going to impact sort of the middle, right? Think about sort of someone that's making $100,000 and is a prime, customer, but the economics just don't work at a 10% rate. And so I think that especially in a year where, consumer strength, affordability is the buzzword, taking away liquidity line from the U.S. consumer is not the move ahead of midterms.
If we were to see some action, though, when it comes to this in Washington, who out of the big banks is best to weather that storm?
I mean, It's always the same answer, right? JP Morgan, even though they're even though they're huge in card, if you run the numbers, they're huge in everything else, and they're so good at everything else, and it's like, it doesn't impact them as much.
Even if the CEO keeps talking.
What's that?
Even if the CEO keeps talking, meddling in Washington.
Look, Jamie's gonna Jamie, right? And he's seen as the leader of the industry and a spokesperson for the industry. So, if he needs to agitate a little, I think that's what the industry needs in terms of, a mouthpiece and a representative of the industry. But look, at the end of the day, it might be, a nick to JP Morgan's earnings, but, having such action would be an extreme impact to the U.S. consumer.
Erica, why do we always walk away from earnings season with JP Morgan talking about Jamie Dimon and not the results themselves? Is there anything in the results that stood out for you?
Look, yeah, of course. Look, I think the reason JP Morgan was off the day it reported is that, investors were used to be, huge, like a big beat and a big raise kind of number. And they kind of previewed what they were expecting for 2026 in October and December of 2025. So there's no really big surprises. And at that valuation, everybody sort of expects JP Morgan to, continue to leap over the high bar they set for themselves. But look, at the end of the day, I think the story is the same for JP Morgan. They lay out a target. The macro environment is pretty, conducive for earning a lot of money, and they're going to leap over it, right? So I think particularly in January, and particularly given the volatility in geopolitics and local and national policy, we did need to hear from Jamie. And that's why Jonathan and Annmarie, what he says sometimes is even more important than what the numbers say.
True, I give you that. I just get frustrated sometimes. Not with you, Erica, of course, just with the general media environment that it's always about Jamie and whatever he's got to say on any given issue, and it's never about the results themselves, Annmarie.
And it's about issues that actually he doesn't have a sometimes serious portfolio on. It's always about like, well, what do you think of Ukraine? And it's something.
Tell me about foreign policy.
Right, and they just came out with these numbers, and people want to know about China or Kyiv from him.
Erica, as you say, though, there is this faith in their ability at JP Morgan to hop over the hurdle, to ultimately whatever they put up, they'll beat. Do you have that same faith in Bank of America off the back of the Investor Day delivered at the end of last year? Do you have that same faith?
No. Look, I think the valuation is definitely unchallenging at Bank of America. And, the engine is there. But, there is a reason why, sell-side analysts like me get attracted to the valuation, and then the market gets a little bit, disappointed. It's just they don't execute as well as JP Morgan. And so, at the end of the day, I think, the company really needs to take advantage of the first quarter, conference season and smooth out and be very clear about the messages that they meant to convey during Investor Day, which is that they're poised to grow revenue and they're going to, make sure that falls mostly to the bottom line, and they're going to control expenses relative to the revenue opportunity. I think the issue here is sort of the opposite of JP Morgan sometimes, in that, the communication is perhaps not as precise, it's not as clear, and the investor base gets frustrated. So, it's almost the opposite, right? If you just look at the numbers and don't listen to the call, you might actually come away with a better conclusion on how the stock trades, right? Whereas everybody, to Anne-Marie's point, listens to the JP Morgan call and just ignores the press release and the supplement. And so, I think Bank of America has, big shoes to fill if it wants to be anywhere near close to its closest peer, JP Morgan.
Erica, appreciate your take as always. Thanks for joining us today. Erica Najarian there of UBS on the likes of JP Morgan and Bank of America. The winner of the week, though, Morgan Stanley, Goldman Sachs. Goldman Sachs positive for 8 consecutive weeks. The rally continues.
They had unbelievable numbers when it comes to Goldman Sachs. Some of these fees, when it comes to deal making, when it comes to the equities trading division. And Goldman Sachs and Morgan Stanley, and I hear Erica. She thinks that JP Morgan, even if something was done with credit cards, would be the best to withstand the storm. But Morgan Stanley and Goldman Sachs actually are more insulated from that story if that legislation were to pass down in Washington.
Equity futures this morning rolling over just a touch. We're still positive by 0.2%. In the next hour, we'll catch up with Stephen Parker of JP Morgan Private Bank, Clayton Siegel of CSIS, Jill Carey Hall of Bank of America, and Vishal Kanduja of Morgan Stanley Investment Management. The second hour of Bloomberg Surveillance, just around the corner.
The economy overall doing strong.
If you look at the underlying trends in the U.S. right now, you're not seeing much inflationary pressure.
I am still concerned that this is a labor market that is gradually weakening.
We have a pretty good sense of where the economy is heading. We're about to see growth inflecting higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
When I first moved here, I used to say, why do you need a holiday this early in the year? Just had Christmas and New Year. Why do you need a holiday? 2 weeks into 26, I need a week. Never mind a long weekend.
You got to recover, whether it's from the holidays or just from the onslaught of policies coming out of Washington. What was it, just only a week and a half ago? Was the capturing of Maduro?
Yeah, that feels like a lifetime ago.
A decade.
A decade ago. Live from New York City this morning. Good morning to you all. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P 500 up by 1/10%. The Nasdaq up by 0.5. What a run for the Russell. Up so far this year by close to 8%. Up again this morning by 0.2%. Long weekend coming up. Looking ahead to next week. The big one's on Wednesday. The President of the United States, Donald Trump, addressing the World Economic Forum in Davos, Switzerland.
So this is the White House thinking that the World Economic Forum is filled with a lot of globalist, elitist individuals, and yet the president is going to come there, probably going to go after a few individuals in the audience that don't always acquiesce to him or don't always line up on his policies. But he's going to have a message for Americans back home, because we know that he's going to talk about housing. Today in the Oval Office, he's going to talk about the fact that electricity prices are too high for consumers, so the tech companies need to subsidize those electricity prices. And we know that potentially he's going to talk about geopolitics and defense, and the fact that the administration wants to see the defense sector really shore up more in the United States and not give money back to shareholders.
This is not just a Republican position. It's a Democrat position as well. And the first thing you pointed out earlier on this morning is he'll be alongside the Democratic governor, Josh Shapiro of Pennsylvania.
Of a swing state, an individual that might be running for the presidency of 2028. So he's not just lining up with, I could see him lining up with Glenn Youngkin, especially given the fact that there's a huge concentration of data centers in Virginia. But he's going to be joined by Josh Shapiro. Josh Shapiro was almost the vice presidential candidate to Kamala Harris. So we have seen the president really go across the line when it comes to wanting to work with Democrats because the policies are populist. In this week alone, he's not just standing next to Josh Shapiro, he called Elizabeth Warren. He is texting with Zohran Mamdani, a Democratic socialist in New York. You have to think, is he calling French Hill? Is he calling individuals that are more the conservative wing when it comes to fiscal conservatives in Congress? I don't think so.
Corporate America has got to be worried when you look down to Washington and realize this is not just a single party issue. This is a bipartisan push now that's going to cross tech, home builders, defense companies, the lot. We've gone after so many different things. Corporate pay, stock buybacks, investing in single-family homes. The list is getting longer and longer, and it's only January 16th.
And taking outright equity stakes in some of these companies. These are policies that individuals like Bernie Sanders would run on. Bernie Sanders literally wrote the bill for a 10% interest rate cap with Josh Hawley. And that got introduced last year. So these are policies that, you're right, if you're the C-suite, they're not going anywhere anytime soon. And you brought up a great point. I'm so focused on the midterm election because that's this year. That's here and now. That's my everyday. 2028. What policies are going to be different? Maybe just some social policies.
Yeah, and they're the most divisive ones at the moment for sure. And if we turn the volume up on those into 28, it's going to be an interesting 2 years ahead of us. Equity futures right now in the S&P 500 positive by 0.2%. Coming up this hour, we'll catch up with Stephen Parker of JP Morgan as tech revives a record rally. Clay Siegel of CSIS with oil steady as Iran tensions cool. And Jill Carey-Hall of Bank of America as the Russell 2000 outperforms the S&P 500 for a 10th consecutive day. We begin this hour with stocks near all-time highs. Stephen Parker of JP Morgan with an S&P bull case of 8,200 by year-end, writing AI remains the defining force in markets. The momentum is broadening beyond hyperscalers and semiconductors into utility software and infrastructure. Stephen joins us now for more. Stephen, good morning.
Morning. Good to be here.
We've certainly seen this rally broaden out. Equal weight, record highs, small caps. We've talked about that run repeatedly throughout this morning. Is that just an early year rotation that loses steam or something you want to get behind for the year ahead?
No, we actually think that it has legs in the year ahead. Last year, as we talked about, was all about AI and technology, whether it was the economic growth, the capital spending, the earnings growth. This year, we think it's a story about broadening. We think that there is a cyclical recovery in the cards. We see that because we think labor markets will continue to stabilize and improve. You have easy monetary policy and tailwinds from fiscal policy. And I think that sets you up for a broadening of the growth story.
Is it a story that demands rate cuts? Or is it the fact that we don't get rate hikes and good growth and that's good enough?
Yeah, it's more the latter. I mean, our base case is we think that we get one additional cut in the course of this year, which is a little bit lower than what markets are pricing right now. And that's based on the idea that we think that growth is going to improve. Inflation remains a little bit sticky, but moves in the right direction. And so it's not predicated on rate cuts.
Within tech, can we just get into the pieces that are working and the pieces that aren't?
Yeah.
I can pick out a single name. I know you can't speak to it, but Microsoft has really underperformed. It's lagged. We haven't seen that pickup in that stock at all. Other software names you can identify too. What do you think is going on within technology stocks at the moment?
Yeah, one of the biggest challenges that we've seen within the tech space, and there was a lot of dispersion in terms of performance last year and continuing into this year. I think the software sector in particular is one where markets are pricing in some questions about what the impact of AI is going to look like for a lot of these software names. It's why we've been focused more on some of the hyperscalers, the semiconductors, as the place that we would play. Ultimately, though, it's going to be the software companies, both public and private, that are going to be building the applications on top of this AI infrastructure. And we think over the coming years, that's going to be a key theme for our clients and our portfolios.
You have one line in your note that really stood out to me. While politics should not derail your plan, we must also recognize that policy can have a meaningful effect on fundamental drivers of growth and inflation. You're talking about these AI players. Companies like Microsoft are saying they are going to basically subsidize consumers' energy. Does that chip away at their margins?
Potentially, but I think not enough to stall the long-term growth prospects. You know, in our 2026 outlook, we talked about three themes that we think are going to drive markets in the coming years. We talked about AI, we talked about inflation, and we talked about this idea of increasing global fragmentation. That's a little bit of what we're continuing to see play out in markets. And one of the key themes that we're talking about for 2026 is this idea of national champions and strategic industries. We've seen it around the world. Places like Europe are making a commitment to invest in their security and defense industries, and we're starting to see it here in the U.S. And we think that that commitment is real. We think that the fiscal spending is going to continue to pick up, and that those strategic industries are going to be beneficiaries of a lot of spending. That's an investable opportunity.
You want to invest in companies that the U.S. government might be taking equity stakes in.
We want to invest in industries that we think the U.S. government is going to consider strategically important. So think about things like industrials, utilities, companies related to the AI power story. We think there's going to be a massive amount of investment in those companies, both public and private. And therefore, there's a fundamental story there.
Long term, though, do these companies do well? Doesn't this overall mean less competition?
I think we want to be careful about swinging too far away from the free markets that we've enjoyed and benefited from for so long. But I think there's also a recognition that in an increasingly fragmented world, there are certain parts of the economy and the market that are just so strategically important. We can't afford to outsource things like rare earth metals. And we're seeing that recommitment to investment here in the U.S., and we don't think that's necessarily a headwind to long-term growth and performance.
Listening to you, Stephen, just tracking what the governments are doing, I understand, I think we all do, they want to invest where the perceived constraints are going to be in the future. It sounds like you want to be alongside them potentially. Where are the so-called perceived overcapacity issues starting to already come up that are bumping up against those constraints? Where don't you want to be on this AI trade?
You know, I think the places that we are more conservative around in the AI space, we are more conservative around the energy story. We talk about overcapacity. There's a lot of focus on power and the need for energy to power these data centers. We do think when you look, for example, at the price of oil, that's going to remain under pressure. There's huge amounts of oversupply in the market already. If Venezuela begins to come back online, that's potentially another boost to supply. And so energy is one of those places that some may consider a strategically important opportunity, part of the AI story, but not necessarily one that we see as compelling from an investment perspective.
Brent crude this morning, 64.57. Is that price a beneficiary to, say, the consumer trade at the moment? If you're short energy, are you long discretionary?
We do like discretionary, although you have to remember discretionary is a very diverse set of companies. Overall, one of the things that's important, you do have lower energy prices. You also have the tailwinds coming from one big beautiful bill, the fiscal stimulus, tax refunds that are coming. And so part of this broadening cyclical story is a boost to the consumer, which should be reinforced by that labor market stabilization that we also expect.
So when you think of the White House pushing out a lot of this affordability campaign, the president still talks about a tariff dividend, although I don't think we're going to get it. consumer discretionaries will do well. What else could do well in this affordability push?
I think the other thing that we're focused on as part of this, tax refunds give kind of the big headlines around this fiscal policy, but a lot of it also has to do with accelerated depreciation. And one of the things that we think is going to be a theme for this year is this ramp up in broader cyclical capex outside of just the AI story, which was the thing last year. And so when we think about industrials, when we think about the build out of infrastructure, that's another potential fiscal beneficiary that we think is compelling.
What about housing? Because there's a lot of emphasis on that right now by the president.
Yeah, I mean, housing is going to be one, there's a question this year, particularly leading into midterms, about how do you separate, sort of the discourse versus what's actually going to happen. We expect that there's going to be lots of proposals, lots of headlines about potential policy. How much of that actually gets implemented remains a question. And historically, that's been the case around elections. So we tend to be remiss to lean too much into specific policy actions and what it might mean. For the housing sector, there is a long-term structural problem. There is a supply-demand imbalance that needs to be addressed. Whether that's going to be something that plays out in the coming months, I'm a bit more skeptical.
Stephen, good to see you. Thanks for dropping by. Stephen Parker there of JP Morgan Private Bank. If you're just joining us, equities this morning positive by 0.2% on the S&P 500 with an update on stories worldwide. Let's check base. Check up with Bloomberg's Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Thank you. Ukrainian President Volodymyr Zelensky speaking in Kyiv today, saying that negotiators are heading to the United States to effort new security guarantees. President Zelensky says he hopes to finalize a deal soon, possibly even as early as next week at the World Economic Forum in Davos, Switzerland, where US President Donald Trump is set to speak. Canadian Prime Minister Mark Carney is in China meeting with President Xi Jinping. It's the first visit by a Canadian leader in 8 years. Carney has been seeking to rebuild relations with Beijing and reduce Canada's reliance on the US after President Donald Trump imposed sweeping tariffs. The two countries reaching a wide-ranging agreement to lower trade barriers. Netflix winning global rights to stream Sony's films after they complete their run in theaters and on pay-per-view. The deal expands an agreement first struck in 2021. The company is saying Sony Pictures will start appearing on Netflix this year as individual territory rights become available. That is your Bloomberg Brief. John.
Vonnie, thank you. Thank you very much. More from Vonnie in about 30 minutes' time. Up next on the programme, keeping one eye on Iran.
The president and his team have communicated to the Iranian regime that if the killing continues, there will be grave consequences. So the president and his team are closely monitoring this situation.
That's up next with Clay Siegel of CSIS, live from New York City this morning. Good morning. Two hours and 15 minutes away from the opening bell with equity futures positive here by 0.2% on the S&P 500, up by 0.5 on the Nasdaq, on the Russell. What a week again for the Russell 2000. The small caps higher by 0.3%. Under surveillance this morning, keeping one eye on Iran.
The president and his team have communicated to the Iranian regime that if the killing continues, there will be grave consequences. And the president received a message, as he revealed to all of you and the whole world yesterday, that the killing and the executions will stop. And the president understands today that 800 executions that were scheduled and supposed to take place yesterday were halted. And so the president and his team are closely monitoring this situation.
So here's the latest this morning. According to reports, the White House moving a carrier strike group to the Middle East. President Trump saying he'll hold off on attacking Iran after a crackdown on protests in the country. Bloomberg's Tyler Kendall joins us now for the latest. Good morning, Tyler.
Hey, John, good morning. Well, reports of this carrier strike group moving to the region comes on the heels of the Wall Street Journal reporting that President Trump has asked for the necessary military assets to be in place should he order a large-scale strike. Yet that report goes on to say that advisors have cautioned the president that a bigger attack is unlikely to cause the Iranian regime to fall. Bloomberg Economics say that the presence of a carrier strike group is likely a signaling tool. It wouldn't be needed if the U.S. were to pursue more tailored strikes or target leadership options we know are on the table, which is why our analysts are calling this all part of strategic ambiguity. And adding to that ambiguity, perhaps, is that we have seen a shift in tone from President Trump over the past week, appearing to narrow the possibility that an attack is imminent. After just earlier in the week, he had urged Iranians to continue protesting and pledged that help was on the way. But according to the president, he has received assurances that the killing is stopping. And as you heard the White House press secretary outline there, a top Iranian official has pledged that they are not going to carry out planned executions. But John, we have really seen the death toll surge in Iran over the past 7 days. According to statistics cited by Bloomberg News from the Iran Human Rights Group, they are estimating that at least 3,400 protesters have died in what is considered to be the deadliest crackdown in the country in decades.
Absolutely horrific when it looks like that blackout continues, Tyler. We've also seen a lot of diplomacy. The Mossad director is in Washington, D.C., according to Axios, to meet with Steve Witkoff. You have Senator Lindsey Graham going over to Israel. Where is Congress in all of this? And can you give us a little bit of insight on some of these back-channel diplomatic dealings?
Well, it is also so interesting, Annmarie, because, of course, President Trump earlier this week said that he was canceling all meetings between U.S. and Iranian officials. But we know that there is this diplomacy going forward, as previous White House officials have suggested that that is always going to be an option on the table. Now, it depends who you talk to on Capitol Hill, but we have definitely heard from some perhaps more hawkish members. You mentioned Senator Lindsey Graham, who yesterday told reporters that he would prefer a bigger strike compared to targeted strikes and to take this opportunity to capitalize on what has been this perhaps more interventionist sense from the Trump administration on the heels of what happened last week in Venezuela with the capture of Nicolas Maduro, and also President Trump's ramped up rhetoric when it comes to Greenland. It feels like we are talking about all of these different countries and possibilities in almost the same breath this week in terms of what the White House is going to do. It is clear, though, that no matter what President Trump does pursue, it appears that he does have the backing of Republicans on Capitol Hill, because, Annmarie, earlier this week, we did see Republicans walk back their support of a war powers resolution that would have curbed the president's authority when it comes to Venezuela. Of course, Iran is a very different story, but it just goes to say that he has been courting their support on the Hill for military intervention going forward.
Tyler, thank you. Thanks for catching up with us. Tyler Kendall there for the latest in Washington. Clay Siegel joins us now, Senior Fellow for Energy Security at CSIS. Clay, welcome to the program. Taken together, the developments in Venezuela, the potential for developments in Iran, is this energy positive or energy negative?
Hey, good morning, John. Well, it seems clear that there is more oil supply that is potentially coming into risk of disruption when we think about how the Trump administration is approaching some of these challenges around the world. I think that the oil market, conventional wisdom, has it right when it comes to Venezuela. The next big strategic move for oil in Venezuela is to have more supply in coming years. And obviously, that's a moderating effect on oil prices globally. In Iran, though, it's way too early to say what the next move is likely to be. And I see actually a high likelihood for at least some disruption of its 1.5 million barrels per day of exports to global markets.
What can that mean for the Brent price if we were to get serious disruptions because of what is going on in the Middle East?
Hey, Annmarie. Well, it means that there's definitely upside potential for Brent. And I think that the market will be looking, as always, to discount both the volume, the size of the potential disruption, and its duration. And we have to keep in mind that as we start the new year, oil market fundamentals globally look pretty ample. They look well supplied, some would say even a bit loose. And so we are expecting an overhang of supply relative to demand, at least for the first quarter. And so that does provide a bit more cushion, as does OPEC Plus's policy of, for the most part of last year, adding some supply to world market. And so we have adequate cushions for the time being. I think that you started to see a little bit of risk premium tick its way back into the market. So we got into the 60s for Brent, but kind of unwound as it looked like maybe the White House and Washington were taking pause, either to allow time for more resources to make their way into the region to give the president more options, or potentially more thinking on the strategic level, what military options really accomplish U.S. interests when it comes to supporting the populace in Iran.
Clay, how important is that energy cushion to the United States in these conversations at the Oval Office, whether or not they decide to take a strike on Iran?
Well, I think it has to be important. Naturally, we are entering campaign season in the United States, and eyes in Washington are starting to turn toward election season. So gasoline, fuel prices, and overall macroeconomic performance will be foremost on leaders' minds and politicians' minds. So no one's looking for a fuel price spike into 2026. But I do think that the overall ample supply relative to demand in the oil market gives a degree of cushion and probably allows policymakers to think about military options and other strategic options in a different way than we would if we were tighter. If you can imagine all the way back to 2022, after the Russian invasion of Ukraine, we had a very significant spike, thinking that Russian supplies could exit the market altogether. At the end of the day, they weren't removed from the market, they were just reshuffled. But those Russian supplies are still a target of policymakers. You were just mentioning Senator Graham in the colleague's last piece. He and his partner, Senator Blumenthal, have been big advocates of cracking down on Putin's war chest, which comes largely through those oil revenues. And so these are some of the dynamics that are shaping leadership's views about how to handle these flashpoints around the world.
Given these flashpoints and disruptions we could see not just from Iran, but to a great point, what's going on in Russia, can we get close to the president's target of $50 a barrel?
Well, that's going to be tricky. And I think that one of the important lessons that was learned from the first year of the administration is there's limited effect from policy initiatives on materially increasing supply. Last year, it was about the U.S. oil patch. So we started the administration with all the talking points that y'all know: drill, baby, drill, unleashing resources. To be sure, there are policy moves that can improve margins for E&P sector operators. But at the end of the day, it's not really up to politicians to determine how much is invested in increasing supply. It's about market sentiment, and it's about capital market decision-making, and it's about those investors, because investors are not as concerned about energy dominance. They want energy dividends. And if the break-even price of a new well in the United States is $65 a barrel, then targeting toward 50 is going to cause a lot of concern among those producers, and they're probably going to pull back some of that oil field activity. And I think the same goes for Venezuela. It's a similar concern that if you don't have those break-even prices to be profitable in the coming years, it makes the investment case pretty challenging.
Clayton, I want to talk about another energy producer, and it's not Venezuela or Iran, it's Canada. Going into last year, I just had in mind this idea that we'd have this North American energy powerhouse. At the time, I was thinking maybe we'd end up with a conservative leader in Canada. Then things changed really quickly with the relationship between the US and Canada. Clay, this week, you've had Canada basically align themselves to some extent with China. Clay, what's going to happen to Canadian energy?
Well, I think that a lot of attention has to be paid to the emerging dynamic between Ottawa and Washington. And if you think back even less than a year when we were talking about Liberation Day and other very aggressive tariff programs, it was conceivable that we were going to have a real rupture in the strong historic energy relationship between Canada and the United States. So our biggest supply of crude imports, it's not the Middle East, it's not other parts of the globe with these flashpoints, it's Canada, right? With more than 3 million barrels a day, adequately supplying those refineries in the Midwestern United States that are perfectly matched to Canada's type of crude oil. And so a lot for prices depends on whether or not we're able to keep. Right now, those supplies from Canada are kind of ring-fenced and off limits for tariffs, everything under the UCMA. But we'll see whether the relationship between the Trump administration and various actors around the world, including Canada, can remain positive enough for energy to kind of stay out of the crosshairs.
Clay, it's good to see you. Thank you, sir. Clay Siegel there of CSIS. On that last point on Canada, the recipe's there, all the ingredients for a great relationship, and it just feels like it's still falling apart.
And the about face from Canada when it comes to what's going on with China, this new strategic partnership. Remember the previous administration with Trudeau? It was all-time low between Beijing and Ottawa when the extradition spat regarding that Huawei executive. This really feels like very new for these two countries.
It's an important development north of the border, that's for sure. Up next on the programme, Jill Carey Hall of Bank of America as small caps outperform to start the year. From New York, you're watching Bloomberg TV. Just about in the red for the week so far. Looking to change that at the open and Bell. Equity futures positive here by 0.1% on the S&P 500, up by 0.5 on the Nasdaq, and the Russell doing okay, up 0.25 of 1%. That's how stocks are set up 2 hours away from the opening bell. Let's get you some morning movers. Danny has more. Hey, Danny.
Hey, John. It still is those memory chip stocks that are dominating in this pre-market trade. Micron, easily the best performer in the S&P 500, the pre-market up 5.5%. SanDisk up 5.4%. It is this rally been ignited by the shortage of memory chip stocks and the huge premium, the cost that they are able to command. By the way, one of the board members of Micron also just put in a filing buying millions worth of the shares, also helping things out here. Micron's up something like 220% over the past year. It's not just memory chip stocks, it's the other AI-related equities that are doing well this morning too. The chip makers like NVIDIA, Intel, and TSMC continuing their rally after a strong set of earnings from TSMC yesterday, lifting the overall sector. Finally, another set of earnings. We got one from a biotech company called Immunity Bio, a whopping 19% gain in the pre-market. Specifically, their bladder cancer drug, they predicted sales for the full year will surge by 700%. Considering this is a smaller company, that's why you can see such a big rally just off the back of one set of results, John.
Big move, up by 19%. Danny, thank you. Thanks for that. More from Danny in the next hour. On our radar this morning, President Trump accepting Venezuelan opposition leaders' Nobel Peace Prize at a White House meeting just yesterday. The president describing it as a, quote, wonderful gesture of mutual respect. Elsewhere, the U.S. getting a higher price for Venezuelan crude than the Latin American country got before the capture of Nicolas Maduro. Energy Secretary Chris Wright telling industry leaders America is selling the oil for 30% more than what was paid for the same barrels 3 weeks ago. And finally, JP Morgan CEO Jamie Dimon expressing concerns about Fed independence as the Justice Department probe into Jay Powell continues.
Everyone I know, including the President of the United States, says we need an independent Fed board. The question is only about when certain things take place, and think of lawsuits and stuff like that, does it chip away at that independence to some spectrum? So you could say a little bit, you could say a lot. If you chip away too much, in my view, this is my opinion, it will drive rates higher, not lower.
Dimon saying he has no interest in being Fed chair, but he would, quote, take the call if considered for Treasury Secretary.
So he'd take the call if it was Treasury Secretary. He said on Fed independence, basically, on being the Fed chair, absolutely, positively, no chance, no way, no how, for any reason would he want to take that job. So he clearly wouldn't want to go over to the Fed. Interesting, he'd like to go over to Treasury. I don't think that's in the cards for him under a Trump administration. He might have to wait and see who wins 2028. Also, Jonathan, interesting, he says the reason why he doesn't really want to do any of that is because he doesn't have a boss, hasn't had a boss for 25 years, and he likes it that way. Not sure the shareholders view it as such.
Yeah, I think they see it differently, but ultimately the shareholders like who the boss is at the moment, and we've seen a massive rally on that name over the last several years.
So shareholders don't have anything to worry about because he's not in consideration to become Fed chair. And at this moment, he's definitely not in consideration to become the Treasury Secretary under this Trump administration. But this is potentially something that I think for years, really, we've seen opinion pieces from Jamie Dimon talking about this. Maybe under a Democratic president, he could be a Treasury Secretary.
The stock has not had a good week. Real divergence between JP Morgan down something like 6%, at the likes of Goldman Sachs up by 4%. Some real divergence between those names to the week so far. Let's turn back to markets and focus on small caps. Outperformed the S&P 500 for 10 consecutive sessions. Jill Carey Hall of Bank of America writing, good start so far, and we expect them to lead for the year. Jill joins us now for more. Jill, welcome. It feels like a change. I've talked about it repeatedly. It's not about the Fed anymore or interest rates. What is it about now?
Thanks. I think it's about earnings and, really confidence in that earnings recovery for small caps, because that's what investors haven't had for the last several years. The recovery in earnings kept getting pushed out. Usually small cap earnings recover faster, and they didn't this time. They were obviously hit by higher interest rates and, tariffs recently. And we've just had a tough backdrop for several years for small cap fundamentals, but and then the manufacturing downturns. But now I think, we're in a period where investors can have more confidence in that earnings recovery, in our view, because we're actually seeing management be a lot more optimistic. I mean, usually corporates are more cautious, but they're guiding up. They're telling analysts your estimates are actually too low, and analysts are penciling in a high teens growth rate for small caps this year. So we found that in periods where growth is accelerating and where small cap earnings growth is better than large cap earnings growth, those tend to be good years where small caps outperform.
Jill, for some investors, not everyone, the Russell always feels like a bit of a trade, something you put on for a while, it has a great month, and you move away again. With the S&P 500, there's great appreciation of what you own when you own the index. What do I own when I own the Russell?
Well, I think one has to be a bit more selective within small caps than they were historically, at least within the Russell, because it is true that, it's felt like a trade, and we've really been in this, 10 plus year underperformance cycle for small caps. And that's been a bit longer than history. And, usually over the long term, small caps have outperformed for longer cycles. And usually these cycles can last, 6 to 10 years. But it hasn't felt like it recently because we've been in a very long one. But the Russell has deteriorated in quality relative to history. There's, more non-profitable stocks. There's, lower quality, more variable earnings stocks. There's more leverage. And the growth rates for the companies are lower than they were a couple of decades ago. So I do think that's the bear case I hear for small caps, is that there's no good companies anymore. The index is terrible. But I don't think that's necessarily true that there's no investable opportunities in small caps. I think there's a lot. Our analysts here at BofA cover about 1,000 small and mid-cap U.S. companies. And, within that, there are a lot of opportunities of attractively valued stocks, ones that are seeing accelerating earnings. So I think one needs to be more selective, but I do think that this will be a good year for small caps and the Russell overall.
Could it be a good year even if the Fed stays on hold for all of 2026?
I think, that one of the catalysts that caused small caps to start outperforming was, Jackson Hole and the Fed Chair's speech in August, giving investors confidence that rates were going to be moving down. And over the last 2 years, we've seen that the Russell 2000 has become very sensitive to Fed expectations. So it tends to underperform in weeks when those cuts were pushed out and vice versa. So, I do think that having expectation of continued Fed cuts is important to be supportive for the Russell. And if those cuts start getting priced out, or if we were in an environment where it looked like the Fed were going to hike, then that would certainly be a more challenge to the bullish call.
You also mentioned tariff rates and how lower tariff rates likely would be very beneficial for small caps. How closely are you watching what the Supreme Court decides when it comes to IEEPA? And can we see small caps really get a boost if they decide that President Donald Trump's IEEPA tariffs are illegal?
Right. On a relative basis, small caps are certainly the ones that are most hurt by tariff rates and higher input costs because they have the thinnest margins. And, some say small caps are more domestic, but the foreign exposure of small caps relative to large caps, that gap has really narrowed, in recent years. So the IEEPA tariffs make up about 2/3 of the current effective tariff rate of about 15% that we're assuming. So, if those go away, there are obviously other avenues the administration can use to try to bring back some tariffs. But our economists would expect that if IEEPA is overturned, the overall effective tariff rate could be several percentage points lower. So, yes, I think, but overall, even if they're not overturned, we could see incrementally lower tariff rates, perhaps less uncertainty than certainly last year. So, that could be an incremental benefit to small caps this year as well. I think near term, what we want to watch this earnings season is that companies built up a lot of pre-tariff inventory and they ran out of that in October. So near term, we could see, potentially more of a hit than companies had been indicating so far, but we'll be watching for that in the commentary this earnings season.
Jill, can we just finish on the financials? We've heard from a few guests so far this week that their play for this year is not the big names on Wall Street. It's the smaller names, the more regional names. Are you pitching a similar thing to clients at the moment?
We actually like both. So we like financials across the board in both our large cap and our small and mid cap work. Within small and mid cap, financials have ranked at the top of our quant work when we look at measures like valuations, estimate revisions, how many upgrades versus downgrades our analysts are making in that sector. And the pickup in regional bank M&A helps sentiment for the sector. Our economists have an above consensus view on GDP growth. So a lot lot of positives for the sector, and the large caps, the SIFIs. If we do see deregulation, which to some extent will benefit the mid caps as well. And really, it's a sector that can benefit from productivity, and it's one area within mid caps that we are actually seeing some productivity improvements. So both large and small cap financials look good to us.
Jill, good to catch up. Big month for you, I'm sure, given the outperformance we've seen in small caps already. Jill Carey-Hall there of Bank of America, up by close to 8% so far this month, and only halfway through the month of January. Those two guests, by the way, that we've heard a few times over the last week or so about shifting from the big players on Wall Street to the smaller players, the regionals, the financials. Some people believe that maybe you just go there because you think banks are going to do well this year, but it's the big banks in the firing line down in Washington, and you want nothing to do with that.
And even the Treasury Secretary has spoken about how they want to go back to Main Street instead of Wall Street. Well, think about that in the banks, those big banks on Park Avenue versus the ones that are more of those regional players. And there's been an effort from this administration. Fed cuts, potentially, individuals are pricing in. But is there maybe a manufacturing recovery? Is the tariff story really behind us? An accelerating earnings growth and a push towards affordability, that would bode well for small caps to continue this rally. But everyone says we've been here before. Is it a false start?
The Russells right now up by about 0.2%. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Vonnie for more. Hey, Vonnie.
Hey, John, thanks. President Donald Trump calling on Congress to immediately pass his, quote, great healthcare plan aimed at lowering drug prices and insurance premiums. The proposal would bypass insurance companies by sending subsidies directly to consumers and codifying price drop deals with major drug makers. Ford reportedly in talks with China's BYD about supplying batteries for hybrid vehicles at its overseas factories. Sources telling us here at Bloomberg those hybrids would be exported worldwide, a move that's already sparking political backlash in D.C. House China panel chair John Molinar saying a deal would, quote, diminish Ford's status as an iconic American company. A judge refusing to fast-track a Paramount Skydance lawsuit accusing Warner Brothers of misleading investors about a rival buyout bid from Netflix. Paramount filing the suit this week, trying to force out more details about the $83 billion Netflix proposal. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Equities right now in the S&P 500, up by about 0.2%. Up next, we'll catch up with Vishal Khanduja of Morgan Stanley. Stocks up by 0.2% on the S&P 500, higher by 0.5% on the Nasdaq. The Russell up by 0.3%. Equities continue to rally in the bond market. Just stability for the last several months. 10s at 418, yields higher by just a single basis point. Check this out from Dan Iverson over at PIMCO in the Financial Times. You mentioned this just the other day, Annmarie. I think these quotes are really quite important. We do think we're in a multi-year period of some diversification away from US assets. It's important to appreciate that this is an administration that's quite unpredictable.
Quite unpredictable. Yeah, he had those comments in the Financial Times. So what do you do when what usually your bedrock is quite unpredictable? You look for opportunities elsewhere. And that's why you are seeing investors say, actually, we need to add exposure to the world, to global equities or potentially global sovereigns, because we are concerned with the unpredictability out of this administration. And what are we, 16 days into January 2026? And already we've seen policy whipsaw and policy ideas that would fill an entire calendar year.
I keep going back to this, though, and go back to this. Look at the Treasury market.
Boring.
I get it. It's an unpredictable administration. I understand all of those things. But look at those yields, 418. Every single day we do this, we're around 410 to 420, 418, 419 this morning. This market doesn't care.
Even Fed independence. I was really shocked that the market pretty much shrugged off the rare video we saw from Jay Powell coming out at the start of the trading in Asia. Basically, he could have done that video on Friday. He decided to do it Sunday evening, and the market shrugged it off. They don't truly believe that Fed independence at this moment is really on the line. The market at this moment needs more information.
Bond yields just a little bit higher by 2 basis points, still short of 420. Joining us to discuss is Vishal Khanduja of Morgan Stanley. Vishal, welcome to the program. I always start here in the Treasury market and I look for an explanation as to just why we've been so stable in fixed income in America in Treasuries when the rest of the world has been unstable.
Morning. Thanks for having me on. I think directly representative of the policies, even though coming out at different times might have a lot of noise associated with it, but are directly focused on getting better growth in the US and slowly but steadily bringing inflation down. So I think that 10-year part, especially of the Treasury market here in the US, is taking cues directly from that. And there are countervailing forces. There are geopolitical tensions that are picking up that are countervailing to the positive policies that the White House has here, which could be nominal and real GDP positive here in the US. And then the authority that sort of the administration runs with on the Fed side, and that's why the market is pricing in about 2 cuts for the year. So I think some of those countervailing forces, proper positive GDP growth expectations here, I think keeps that 10-year in check. I would say that probably around that 375 to 425 has been our base case for at least the first part of this year into 2026.
Vishal, even with the forces developing in a place like Japan, where yields have really started to break out, we had this conversation with PIMCO earlier this week. In our careers, Japan traditionally has been an anchor for global bond yields. That story has changed markedly. How relevant is it?
Completely changed and very, very relevant. I think we believe that at least the BOJ, very deliberate policy of hiking. And I think you can see it in those inflation numbers. I think it's seeping through to the wage inflation. It is seeping through those CPI calculations that they use to actually pay people in the country. I think you structurally are seeing a massive change in that economy that they've been trying over the last probably 40 years in that country. They went a little off mark with the political tensions going through. I know there is still a little bit more noise coming through in the first probably 4 months of this year, but we do think that they are completely on the path to probably get to that 2.5% neutral rate in the next 3 to 4 years.
Vishal, as you see diverging monetary policy paths, why do you think the U.S. will continue to ease? JP Morgan is saying no more cuts for 2026.
Fair point. I think it's the expectations. Again, if you look back probably the last 3 months, we've taken out probably about 2.5 cuts from the expectations for 2026. The market has been completely benign through that because those cuts have come out because of positive growth expectations, not for a 2022 type scenario where inflation would be spiking higher. So we don't think that if you try to answer the question, do we need cuts in the economy in the US at this rate? Absolutely not. But if you look at the second part of the dual mandate, which is labor market, that is clearly showing that it is weakening. I think if you take a 6-month average or even a 3-month average, taking the real-time data into account, drastic slowdown in hiring. I know we've not seen a big pickup in hiring, but that cyclical slowdown is here. And I think the fear is that there will be a structural slowdown coming, whether it's AI, whether it's productivity gains, that the country might get lucky in the back half of this year. So we do think that 2 cuts, expectations of the Fed being a little bit more dovish given the makeup, is a fair sort of assessment from the market from that perspective. So we don't think that the Fed is that relevant as long as CPI is in that plus or minus 50 basis points range. I think the most relevant part is the White House and the policies and the noise that is coming out of there for the bond market.
But the unemployment rate right now is at 4.4%. Jobless claims yesterday weren't alarming at all. When do you see this shift potentially to take place?
I think the underlying shift is already taking place. I think given that K-shaped economy, given that the lower strata of the economic, part of the consumer is hurting quite a bit more. Not only the jobs are getting lost there, but I think the inflation is hitting a lot more in that part of the economy as well. So I think you're starting to see in the last 3 to 6 months worth of data, even though the overall numbers might not reflect that, given the drastic change in the immigration policy that we've gone through. I think some of the estimates that our team were coming up with, the data that we were looking at, is probably we are down 2 to 2.5 million of immigration. So I think the math on the unemployment rate is not showing us the clear picture, but you can see the structural shifts in the lack of hiring that is going on, and then lower part of that K-shaped economy is suffering the most.
It just hasn't been relevant to market outcomes either, Vishal. We talked about that throughout the whole of 2025, that if I'd given you all that information up front where jobs numbers would be, you would have got the market call very, very wrong. Equities ripped regardless of that. Credit spreads are super tight. Looking at high yield spreads on a Bloomberg terminal this morning, around 250, Vishal. How tight are we in your mind? Too tight, or can we keep grinding tighter from here?
I think we are tight, reflective of the strong fundamentals. It is the highest quality high yield market that we've ever seen, not just my lifetime, but just ever in the high yield universe lifetime. Highest amount of double Bs, highest amount of secured bonds. Now, yes, thanks to some of the private credit, thanks to some of the other parts of the leveraged credit market that we've cleaned up that. But part of that is also that robust growth and earnings that have taken place over the last 3 to 5 years. So I think those spreads are very reflective of these strong fundamentals, continuing on, even at slightly lower growth, but continuing on with those strong fundamentals. And technicals have been extremely strong as well. So overall yield levels, again, going by the bond math, I think overall yield levels that define a greatest predictor of total return going forward in the next 3 to 5 years have been robustly high. So you put that mix in, we think that it is commensurate to the strong fundamentals that you're seeing in the high yield market. So we are actually overweight high yield and we are underweight the long end of the very high quality investment grade market, which we do think has to absorb a lot of that supply coming from that AI data center infrastructure build out that the US will go through. So great for growth, but the balance sheets will get strained on that very high quality part.
Let's just sit on that topic, Vishal. I think it's really, really important because, as you know, a lot of people have been tracking this story. The fuel for the tech capex has moved away from cash flow, and now we're talking about debt. So let's get into the debt piece of this. What kind of borrowing demands do you expect to see in the next 12 months, and how does that speak to the developments you're anticipating?
I think if you look at the first 6-7 business days here, Jonathan, I think we've seen books have been drastically oversubscribed. I think we've issued probably about 150 billion close to an investment grade market. High yield has started to pick up. Securitized side is starting to pick up. We've not seen a blip in that demand and the robust demand at these tight levels that we are seeing. So demand is there because we still have that sort of the math-driven buyer or the overall yield-driven buyer that is still putting money into fixed income. And I think fixed income dynamics have, even though very similar to starting point of 2025, has slightly changed, where yields are still high, spreads are still tight, but curves are now steeper and equity valuations are further stretched on the other side. So I think even more compelling sort of inflows into fixed income. And I know we debated all last year, how's that 6 to 8 trillion of cash? When is that going to move into fixed income? As curves get steeper and the delta between what you're getting into a money market versus what you get into a 5-7 year part of the Treasury or a corporate curve, I think that becomes even more compelling at this sort of point in the cycle that we are here in the economy. So we do think that the demand remains robust. As dispersion picks up, yield is still high, the total return potential remains pretty intact for 26 and 27.
Vishal Clinic, good to hear from you. Thanks for dropping by. Vishal Kanduja there of Morgan Stanley on fixed income and the amount of supply we might see through the year around that AI theme.
Absolutely. The AI market, everyone is now looking at debt. And you continuously bring this up. OpenAI, that IPO is going to be incredibly interesting. And that, for a lot of people, could be make or break as a litmus test for this entire trade. And when you talk about AI debt and this circularity of it, how well OpenAI does is going to be huge.
Up next on the programme, we'll catch up with Matt Sturkey of Northwestern Mutual. He'll weigh in on that theme. Momo Ku of PSP Growth will join us. Stephen Stanley of Santander and Mona Mahajan of Edward Jones. The third hour of Bloomberg Surveillance up next.
Corporate sector is doing great.
It's all about earnings.
The headline on 2026 is the noise continues to be noisier and ratcheted up.
I think investors, to be fair, are keeping their eye on the ball.
There has been a lot happening in the face of what has been largely a resilient equity market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P 500 positive by 0.1%. The equal weight at all-time highs. The outperformance, small caps. The Russell up by another 0.1% this morning. In the bond market, remarkable stability. We've been talking about it all week. The 10-year bond yield still sub 420, 418.93, with yields higher by 2 basis points on the session, but still a very range-bound Treasury market. You heard Alicia Levine of BNY talk about the noise getting noisier. It's been very noisy. You'll get more noise next week. The World Economic Forum, Davos, Switzerland, kicking off early next week. And the headline event, the President of the United States kicking things off on Wednesday for the U.S. delegation.
And he's going to be talking about affordability back home in the United States of America, and probably telling the World Economic Forum that what he would call the globalist elites haven't delivered for the everyday person. And Jonathan, he's going to continue that message today when he's flanked by even Democratic governors reaching to the other side of the aisle, talking about how tech companies are going to have to subsidize electricity bills for consumers. Next week, you're going to hear a lot about housing. You don't want to see rage bound with the Treasury market. What's the next catalyst? Maybe the Supreme Court, maybe the Fed decision. But right now, a lot of noise coming out of the Oval Office.
Let's focus on one piece of that. So tech, the technology story. Electricity is going to be a massive issue. Energy costs for politicians the world over, not just the United States. That piece of it gets my attention for next Wednesday. The president making a push and really sending a message to the tech players. You need to do something about it.
And some of these tech companies already got the message, like Microsoft, and they're saying they're willing to pay that higher rate because they are the ones that are getting involved when it comes to the data centers. So the tech companies, the AI companies, are going to potentially be on the chopping block when it comes to the president's speech. He may call them out. You know, all of last year, it was about him looking for his friend Jensen Huang, whether or not he was in Riyadh or whether or not he was in Japan, looking for his friend that he wanted to talk about, this individual that is helping the stock market. Well, actually, he might start looking at the tech companies and saying, you guys made enough money. Now we have affordability crisis. We have a midterm election year. You might have to pay up for some of this.
Full coverage right here of Bloomberg Surveillance on the World Economic Forum in Davos, Switzerland this coming Tuesday. We'll kick things off for you in Davos, Switzerland in a few days' time. Coming up on this program, Matt Stuckey of Northwestern Mutual Wealth Management with stocks trading near all-time highs. Momo Q of PSP Growth as President Donald Trump is pushing for tech giants to pay for surging power costs. And Stephen Stanley of Santander calling for no Fed interest rate cuts for 2026. We begin this out with stocks aiming to end a roller coaster week on a positive note. Matt Stuckey of Northwestern Mutual Wealth Management writing earnings revisions are responding across a variety of equity asset classes, which is directly improving the breadth of the market with strength in areas like US small caps. Matt joins us now for more. Matt, welcome to the program. Repeated this question a few times already this week. I think it's the number one question with regards to small caps. Just a trade or something for the long run?
Well, we certainly have had our full share of false starts over the last few years, but I think this is probably the stickiest rotation that we've seen over the last 3 years because those earnings revisions continue to be up and to the right. Since small cap earnings on a forward-looking basis in mid-May bottom, everybody's been talking about the Russell 2000. That has led the rally higher, not only in terms of the markets, but in terms of earnings revisions. Those are up almost 25%. And you contrast that to the S&P 500 around 14%, or the S&P 600, which we look at because they're a little bit higher quality with less of those negative earning companies, up a little bit above the S&P 500. And that allows some of that value dislocation to start to normalize a little bit as you kind of think forward. And so whether it's sustainable or not is the key part is going to be this continued up and to the right movement in earnings revisions. And if you're looking ahead to 2026, the combination of fiscal, monetary, and deregulatory stimulus entering the picture, I think gives reasons for investors to be optimistic about that sustaining.
Matt, typically when there's a better cyclical story to tell, yes, equities do well, yields start to drift higher. It's not necessarily problematic. It's just how sovereign debt markets work, developed markets anyway. Matt, why aren't yields drifting higher in quite the same way this time?
Well, I think you underline a key kind of risk here that, yields haven't really moved a whole lot higher, but they haven't drifted lower either. And I think key here is how the labor market holds up. You have a fantastic labor surprise index over at Bloomberg that I track pretty closely, and how that moves and ebbs and flows somewhat dictates how the 10-year Treasury has been ebbing and flowing over the last year or so, and that has started to firm up a little bit. We've seen just continued low levels of initial jobless claims, and if employment and profits are tied to one another, could be talking about a bottoming in the labor market as we head into the front half of 2026. And I don't know if necessarily people are contemplating that, because the narrative has been so much about labor market softening. And it's just a key risk as we look forward to 2026, whether or not we're going to continue to see improvement in the monetary side of things through the longer end rates.
Matt, what do you think the source of hiring is actually going to be? Because what we've seen so far is a lot of healthcare, and not much else. And what you've seen in terms of growth is a lot of tech spend, investment-led growth, and not much else. Matt, why do you think that's going to change in a different fashion for the year ahead?
Well, I mean, I think if you look at kind of the sources of upside on the cyclical parts of the economy, think housing, think transportation, think manufacturing, those are the areas that maybe potentially improve, that really have not been the areas where job growth has been found in the U.S. economy. Like you said, it's been in the non-cyclical parts, the government jobs, the healthcare jobs. And so if you look to maybe a broadening out, which everybody is talking about, you have to see that probably also include the labor market as well. And so hopefully that's what we see in 2026.
How much is that predicated on basically policies out of D.C.? We're talking about housing. This is something the administration is really taking a laser focused approach on.
I think that is a key component, just in terms of the overall kind of size of the housing investment part of the capex component of the U.S. economy. We have started to see existing home sales respond a little bit. They've been troughing out about 4 million or so year over on an annualized basis. That's kind of the lowest level we've seen since 1995. But in terms of how that market responds to a change in the financing costs, historically, it's always been, a drop in rates or compression in mortgage-backed security spreads relative to treasuries have helped, a cyclical recovery there. And I wouldn't be surprised if we see that. Now, certainly there's affordability challenges, but you don't need to wait for affordability to get all the way back to kind of pre-pandemic levels to see an improvement in activity. And that activity improvement tends to follow with, maybe some firmness in terms of some of the labor side of that industry.
Can we see this increasing investor sentiment and the economy about broadening out happen if the Fed stays on hold?
Well, I'm not sure that they're going to be staying on hold. I do think that there's reasons to be optimistic that by the back half of 2026, we might see a couple more cuts from the Federal Reserve. But even if we don't, we think through some of the compression that we're seeing in the overall spread environment that's conducive to M&A, is conducive to corporate activity levels moving higher. To me, help with overall kind of wealth creation that translates into overall activity spreading out and broadening out throughout the economy.
Well, speaking of wealth creation, anyone holding Google, Alphabet last year, Matt, created some real wealth. You've been offering some details on a tech trade I want to drill into with you just briefly. Matt, 12 months ago, coming into 2025, there was all this talk of existential risk around Alphabet, and then it rallied 60-something percentage points. Matt, how quickly is this story changing from week to week for the winners and the losers of this great theme?
Yeah, I think you underline a key part here, just the back and forth between who's in the winner's circle around, the best frontier LLMs and leading in terms of artificial intelligence, and who potentially could be disrupted. And the market's consensus around that is shifting. In the first 6 months of 2025, Google was underlined as being disrupted. Search was going to be disrupted. And what did they do to dispel that notion? Well, they reported accelerating search growth and unrolled Gemini 3, which really changed the game in terms of the concerns around the level of disruption risk around Google's business. And the concern now is maybe that OpenAI isn't quite keeping pace with Gemini. We're going to get an update to that, though, probably by the first quarter of 2026, when ChatGPT 6.0 comes out, and that's going to be trained on the newest chips from NVIDIA, Blackwell Ultra. And I think For that maybe to be shifting back in the favor of open AI, we have to see scaling laws continue to hold. And so by no means is leadership that's currently being underlined, whether it's Google, whether it's Anthropic or another frontier LLM, we think it's set in stone by any means. There's likely to be continued innovation that's delivered to the marketplace in 2026. And so, if you're an investor here, I think you just continue to have more of a diversified approach versus penciling in long-term winners based on kind of where the landscape sits today.
I'm reading through your note, and Matt, you put in the note this quote from Chase Coleman over at Tiger Global. Less than 1% of current global internet market cap founded in the 2 years after Netscape Navigator came out back in the mid-90s. Matt, how instructive is that quote?
Well, it's one quote that I always kind of just keep in the back of my mind as we're thinking about, these huge market caps that we see today and the level of concentration in the S&P 500, how that might shift in the decade ahead as this technology rolls out and is adopted by industries worldwide. The potential for disruption is high when there is technological innovation to the extent that we're witnessing in the economy today. And, if we're looking 20 years down the road, how does market cap shift between, companies that haven't even been founded yet or haven't gone public yet relative to the level of constituent concentration in the S&P 500 today? We think that's just another underlying case for being humble in terms of having conviction and where the long-term winners are, and also kind of leading into diversification in times of disruption potential.
Matt, appreciate your time. Thank you, sir. Matt Stuckey there of Northwestern Mutual. With an update on stories worldwide, let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Thank you. President Trump accepting Venezuelan opposition leader Maria Corina Machado's Nobel Peace Prize medal, saying in a post on Truth Social that it's a great honor. Machado says she handed it to Trump during their White House meeting as a recognition of his unique commitment to Venezuela's freedom. The US and Taiwan agreeing to a trade pact that would lower tariffs on goods from the island nation to 15%. In return, Taiwanese semiconductor companies will increase financing for their American operations by $500 billion. That includes at least $250 billion in direct investments to expand semiconductor, energy and AI facilities. FedEx is spinning off FedEx Freight into its own independent company. The company filing the necessary paperwork with the SEC today to get the ball rolling. Leadership saying the move will let both businesses focus on their own strengths and deliver better value for shareholders. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you very much. Up next, the morning calls, plus Mama-Q of PSP growth as President Donald Trump is pushing tech giants to pay for power costs. Their conversation up next. Live from New York City this morning. Good morning.
It's going to be a little bit of a tougher climb. So think about what the next sort of leg is in terms of EPS revisions. It might be more like Main Street rather than Wall Street. Small to medium sized enterprises finally expanding. And what I would say is I would look to the regional banks.
Erica Najarian of UBS on the regionals heard a similar thing from Jared Cassidy of RBC. Same issue. Looking away from the bigger players. Had a great run, decent numbers. Stocks aren't responding in quite the same way, with the exception of being Morgan Stanley and Goldman Sachs, of course, over the week so far. Look elsewhere, the smaller names. People looking at small caps. Equity futures look like this morning. On the S&P 500 up by 0.15, on the Nasdaq up by 0.4. Small caps up by another 0.16. Some headlines I want to share with you. This came from the National Economic Council Director Kevin Hassett, with this to say on the credit cards. We've been in touch with the big banks. There will be great new Trump cards from the banks, and I don't think legislation will be needed on credit cards.
So I guess if the banks decide that they are going to release maybe a different type of credit card, maybe one that has a capped interest rate of 10%, maybe 15%, then that would acquiesce Trump's concerns and you wouldn't even need legislation. You can imagine the banks have a war room and thinking about, besides the lobbyists, how they're going to approach this. What I'm a little bit confused about is that I was on Air Force One when the president came out with the gold card. And he said, does anyone know what this is? And I said, it's the gold card. He's like, gold card, Trump card, hasn't decided yet. So now we have a Trump card potentially that's for those foreigners that can invest in America and get access to living here, and maybe a Trump credit card as well if you're a bank. I'm not sure.
Watch this space. Equity futures positive by 0.1%. Let's get you some morning calls. First up, Barclays raising its price target on TSMC, highlighting strong earnings. Elsewhere, KeyBank lowering its price target on Netflix, expecting near-term volatility. That stock up by 0.5%. And finally, Jefferies raising its price target on Nvidia, saying shares, quote, remain pretty cheap given EPS potential. The stock is up by 0.7%. Let's stick with tech. President Donald Trump pushing for industry leaders to foot the bill for new power plants. Sources telling us here at Bloomberg the move would fund some $15 billion of new plants to take pressure off rising consumer costs. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, I'd imagine the tech firms anticipated this. How costly is this going to be?
Well, right now we are talking about 1 gigawatt of AI data center costing about $50 billion. And I'm sure some of those power costs are included in that. But look, these hyperscalers spent almost $400 billion plus in capex last year. And a lot of those investments are going to come online in the next 12 months. So you have to ask yourself, how are they going to source the power? And that's where I think some of that inflation when it comes to sourcing that power is going to show up in this form.
Mandeep, do you think they're starting to fear the societal pushback?
I mean, yes, look, data centers were like low single digit in terms of overall U.S. power consumption. Right now, we are projecting high single digit, 8 to 10% over the next 3 years. So clearly, something has to give because we can't really just bring so much power online in such a short span of time. So the pushback is going to come.
Do you think this is a stock story yet, Mandeep? That every time I get the electricity bill, I'm going to blame Microsoft and Meta. Is that a stock story yet?
Not really, because look, I mean, there are so many players involved when it comes to the supply chains for AI data centers. So you can't really attribute it to one stock, but there's no doubt that, companies are investing heavily, and this is very compute intensive. So you have to ask about the societal impact and what it's going to mean in terms of consumer prices.
Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you, sir. Thank you very much. Mama Q, a venture capital firm, PSP Growth, writes this: AI demand is still significantly outpacing supply. I'm on the side that momentum continues. Mame joins us now for more. Mame, welcome to the show. I'd love your reaction to developments down in Washington, D.C. and whether in any way, shape or form this will constrain or be a story that holds back some of the tech investment we've seen over the last year.
Good morning. Thanks for having me on the show. I think right now that is still speculative, and you're seeing the markets not react super strongly because I do think I continue on the narrative that this shows that demand is very high. This shows AI innovation is continuing at unprecedented pace, and that shows in the number, not just in the energy around the sector, but you're seeing Q4 numbers around consumption, around the large language models be at an all-time high. You're seeing the revenue growth rates of OpenAI, Anthropic, Gemini, and XAI be at all-time highs. And you're seeing consumer behavior change as well. I don't think you and I will ever search for information the same way again. I don't think software coding will ever be the same way again. So while this is something in the market to be talked about, I do think the push around demand and continued demand will be a net positive for the sector.
Could it chip away at their margins, though, of these companies if they are basically going to subsidize the electricity bills of millions of consumers?
I agree. I think net will still be positive because we're talking about a generational technology change. So if you think about the value that was created in the last few technology shift in cycles, mobile, cloud, internet, the eventual earnings and profits far outweigh any short-term compressions in margins. So I think this is going to be a sector that would generate trillions of value in market cap. And I don't think that narrative will change.
You also spent a few days in Silicon Valley. Can you walk us through this three-way AI war you're seeing play out right now?
Yeah, so the three-way AI war we're seeing is one is the existing public software companies that are trying to add AI to their technology. So you think of Salesforce, Adobe, Workday that are adding AI features, adding agentic features. They're coming up against AI native startups that are trying to build new tech stacks and chip away at their corporate share. And then you also have the large language model providers, OpenAI, Anthropic, the ones that I just mentioned, who are now moving from the model layer up to the user and the enterprise. We do think that overall share of corporate spend in AI will increase significantly, but exactly where that will shift among the three different players remains to be seen.
What we've seen develop in public markets has been interesting. The likes of Microsoft has really tried to trade a lot softer. And we've seen all of this money go into, say, hardware and memory. And we've been covering that story through the year so far. What are you focused on? And where do you think that weakness is coming from?
I think the weakness is coming from uncertainty. Right now, there is not just a three-way war that I mentioned, but an overall war around AI in terms of who can pull ahead and who is behind. And I wouldn't be surprised if there is some short-term volatility. But generally, I think the Max 7 is still pretty durable because they're actively investing in AI and trying to hire away AI talent. So it's going to be one of those things, maybe 1 week, Gemini's models are going to be stronger, and another week, you see Microsoft investing heavily in both OpenAI and Anthropic, and maybe they'll pull ahead the week after that. So I think the Max 7 is generally pretty solid. I think where some of the potential vulnerability and weaknesses may happen is in the software companies that are dependent on workflows and user interface for their core business. And I think that's where the vulnerability really comes in from both the model players as well as the AI native startups.
Can I ask you the big question that a lot of people have been asking, which is what happens if OpenAI has funding struggles? What would happen to the whole ecosystem? Who would be vulnerable? And what would it mean for you personally if that was the case?
Well, OpenAI, I would say, if you look at their revenue, they either hit 15 billion or about to hit 15 billion in a very short period of time, something like 3 years or so. So I think at that kind of growth, that's really unprecedented. I can't really think of another company that grew that fast in a short period of time. So I do think that would continue to attract funding and attract interest. And they are they've also have a strong hold on the entire AI supply chain by some of the deals, larger deals that they've made with other players. So this ecosystem is sort of dependent on them, but because both OpenAI and Anthropic and some of the other models that I mentioned are growing at such a fast pace and capturing so much market share, I think the long-term outlook for them, including their funding, is going to be positive.
Mama, thank you. Thanks for making time for us. Mama Q there of PSP Growth on a situation with OpenAI, the tech players, the pushback we're seeing, and a phenomenal growth we're seeing as well. Got to highlight the fact that we're seeing phenomenal growth.
Yeah, off the charts. But ending with MoMA there on OpenAI reminded me of what Matt Stuckey put in his note. In 2025, we went from OpenAI to say, hey, we're going to spend $1.4 trillion to, oh my God, we have code red, all hands on deck. All of this before they're expected to IPO.
The Nasdaq this morning up by 0.4%. A tech bounce back through the week so far, helped out by developments from TSMC and the vote of confidence in the future from that company a little bit earlier this week. Up next on the programme, we'll catch up with Stephen Stanley of Santander, calling for no Fed rate cuts in 2026. He's not alone. We've seen the same story from Mike Ferroli of JP Morgan, and I have to say the signal going into the Fed's quiet period is similar as well. Fed officials lining up to signal basically nothing for the next several months. Up next, we'll also catch up with Danny. She's got your morning movers. PNC rising on a revenue beat. That stock is up by 3%. The open about 60 minutes away. Equities positive by 0.1%. If you're just waking up and joining us, welcome. We're positive by 0.5 on the Nasdaq, and the outperformance on the Russell goes into 10 consecutive days. Can we make it day 11? Not quite yet. On the Russell this morning, up by 0.13%. so far this morning. The opening bout just around the corner. With your morning movers, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John, we're done with the big U.S. bank earnings. Now we're getting some of the regionals. PNC reporting a solid set of results, really helping them with their capital markets business. It was the middle market company mergers that really fueled the results at PNC. So those shares up 3.7%. It's something the company had flagged a couple months ago, and it comes true. Not all regionals did well, though. Regional financials, on the other hand, it was a miss across the board. It was a miss for their EPS. It was a miss for new loans, too. Maybe this company will start to look for a buyer like other regionals have. The CEO, though, saying that the economy looks good. Things are turning around. Not helping them this morning, though. Shares down nearly 4%. Some earnings we got after the bell yesterday was J.B. Hunt. This is the freight trucking business. Also some real weakness for them. A miss, too, on most of their sets of results. The company seeing intercontinental shipments falling quite dramatically, and freighting demand, even though that's low, the supply is very high. Really, the only growth they saw was on the U.S. East Coast, so those shares falling 3 1/3% this morning, John.
Danny, thank you. Looking forward to the programme. Danny Berger and Matt Miller coming up in about 30 minutes' time. As we turn to the economy, Federal Reserve officials lining up to hit pause on rate cuts one day before the quiet period begins. Mike McKee has more for us. Good morning, Mike.
Good morning, John. I'm going to stretch out the week to include last Friday to Friday. And if you look at what we've learned this week from the economic data, you can understand why members of the Fed are saying what they are saying. If you look at both sides of the dual mandate, you can see that unemployment falls and hiring stalls in the jobs report last Friday, and maybe claims under 200,000 sums it all up. Nobody's getting hired, but nobody's getting fired. CPI inflation is steady, but PPI rose, so that suggests we still have an inflation issue out there. The Beige Book cited modest growth, and if that's the case, then it's still not an emergency for the Fed to react to. So we got this in Fed speak, as you mentioned. Obviously, Powell taking on Trump, but the markets tacoed that trade. They're not worried about that. They're more interested in whether rates are going up or down and when. And as you mentioned, we have 5 members of the Fed's Open Market Committee saying there's no reason to cut right now. Donald Trump's also put off his choice of a new Fed chair again. Now he says it'll be within several weeks. That may be tied up with the whole Powell thing. What do we get next week? Well, not a lot of economic data and certainly no Fed speak, but we do have the Supreme Court sitting Tuesday and Wednesday. They could rule on tariffs on either day. And Wednesday, they hear the case of whether the president can fire Lisa Cook. So that's going to be a big day for the markets to watch. Thursday, a revision to GDP for the third quarter and jobless claims again. November spending in PCE as the government catches up on its old data. And Friday, the S&P PMIs, they'll take on outside perhaps influence because there's not much else. And then we get the Michigan sentiment final figures for the month. So really, we're kind of transitioning here from the Fed and economic data to what's happening on the legal side. But that is going to keep people watching very closely.
Mike McKee, thank you, sir. Appreciate the update. Mike McKee there with the week ahead. Can we bring that graphic up just again and just look at things? If you were to script this, you'd probably have that Supreme Court ruling right before the president was about to deliver his speech in Davos, Switzerland at the World Economic Forum.
I thought about this week when we once again didn't get the tariff decision. I said, well, that just means that opinions are next week. Next week, he's in Davos. He's going to be talking to the countries he already negotiated trade agreements with, and potentially his own Supreme Court is going to say, sir, the way you enacted these are illegal. So that speech, I imagine, you said this earlier this week, how many times is that speech going to be rewritten?
Oh, it would be controversial if that decision dropped next week.
Very controversial.
Given that they skipped it this week and last week as well.
And us being very busy chasing around Howard Lutnick and Jameson Greer and finding out who they're talking to behind the scenes, and then going back once again, another year of chasing trade deals will be a lot. But if you're going to script it, this is the Hollywood blockbuster ending.
Let's keep it on the Federal Reserve. Stephen Stanley of Santander writing this. I look for the unemployment rate to stabilise. Inflation is likely to remain stubbornly high. I look for the FOMC to remain on hold for all of 2026. Stephen joins us now for more. Stephen, good morning.
Good morning.
Controversial call if the president's watching this morning. Good morning, Mr. President. Why no rate cuts for the year ahead?
Well, I think what we're seeing now is the Fed has moved into pause mode. And there are at least some on the committee that would like to move further, I think. But what you heard from Powell in December, I thought was really important, where he said that the rate is now within the plausible range of neutrality. So there's no urgency to move. I think that pause turns into a full stop because I look for the economy to do better in 2026 than most assume.
Okay, so we can sort of tease and unpack some of this. So the first half, I've got it. You mentioned Chairman Powell. He's gone. Let's get to the second half. What you're essentially forecasting is whoever takes over the Federal Reserve, and we imagine whoever it is going to vote for interest rate cuts, given that this is what the president is looking for, they're going to be voted down by the committee for every single meeting for the rest of the year?
Well, look, I'm going to take the optimistic tack on this.
Okay, go ahead.
I've always assumed that whoever is the nominee for chair will operate more or less as the Fed has always operated, based on the data. So if it's a close call, I'm sure that a very dovish new Fed chair is going to kind of push in that direction. But they have to convince the entire committee. And if the data are relatively clear, I think that would be difficult. I would also point out, we're not talking about a big break here because Chairman Powell has been a dovish Fed chair. And I think the December move was the latest sign of that. I mean, he very much personally pushed that through, right? That committee was very divided. The decision could have gone either way, and the fact that they moved in December, I think, is clear evidence that Powell was pushing in that direction.
If that's your case, does this set up the new Fed at more of a frictious market relationship with this White House?
Friction between the Fed and the White House?
Yeah, even if it is someone like Kevin Hassett, and you think they're going to operate independently.
Well, I mean, look, I think it remains to be seen. I would say that if the economy is doing better, that is likely to reduce the level of agita in the White House, right? So even if the Fed is not cutting, as the president has suggested he would like, if people are feeling better about the economy and the president is maybe feeling better at the margin about election prospects in November, I suspect the heat will tamp down a little bit on the Fed.
You're basically saying it all is predicated on polling numbers.
From the White House perspective?
Yeah.
I mean,
how much they want to maybe jawbone the Federal Reserve, even if it is someone that the president has decided he wanted to put in because he thinks they're going to be a part of this lowering interest rates.
Well, we've moved into territory where I'm far from an expert. I'm not much of a political analyst, but look, the administration wants to do well in the midterm elections. And I think it's very clear from what we saw last November and kind of the general conversation around politics at the moment that economic issues are going to be very important to voters, right? So are voters feeling good about things? Do they feel more confident in their job? Are they feeling like inflation is less of a concern? Those are things that are obviously going to, if things are moving in a good direction on that front, that's probably good for the president and for the Republican Party and vice versa. So that's kind of what I'm thinking there is that, the reason I have the Fed on hold is because I think the economy does better. Well, if the economy does better, then maybe the sentiment around the economy also improves.
Well, let's sit on that then, the core of your call, a better economy. What's driving it? What are the tailwinds that you've got confidence in?
Yeah, I think the biggest one is that, in my view, a big thing that held us back in 2025 was uncertainty around policy. I mean, tariffs being one of the key pieces of that. And, I've felt for a long time that businesses would re-engage in 2026. Not that policy uncertainty goes away entirely. I mean, that clearly is not going to happen. And there's always some level of uncertainty. But you're hearing a lot more Fed officials who are communicating that their contacts are telling them that businesses are kind of getting ready to re-engage a little bit. So in 2025, investment spending was really just about AI. And if you were to strip out the AI pieces, business investment was probably negative in real terms through the first 3 quarters. I think you'll see a broadening out in 2026, reflecting the tax cuts that were put into place, the deregulatory push, and some of the other things, assuming that the administration kind of ties up some of the loose ends around tariffs.
Will that be accompanied with better payroll growth?
Yes, because I think the same dynamic that has businesses hitting the pause button on investment is also applicable to the labor market. I think there are businesses who maybe would otherwise have hired who are holding off because of that uncertainty. The complication around that, I think, is that now what we're hearing Fed officials saying that they're being told by their contacts in their districts is that there's also now a second feature, which is AI. And do I maybe want to hold off on hiring because I'm not sure if I'm going to need those workers a year, 2 years, 3 years down the line. But I mean, if the economy's growing as it has, ultimately you have to grow your workforce to measure up to that. So I do think we'll see an improvement, not a drastic improvement, but some improvement in the pace of hiring, enough that we should be able to get the unemployment rate down a little bit as we move into the latter part of the year.
Will that growth lift all boats, say the bottom part, if you do believe we're in a K-shaped economy?
That is a very real phenomenon. There's no question that the folks at the lower end of the income scale are struggling more than the folks at the higher end. It remains to be seen whether that dynamic changes. I think that in some ways, what we're seeing over the last year or two is really just a normalization. I think the people at the lower end of the income scale benefited greatly. They got most of the federal government money during the pandemic. We had mortgage foreclosure moratorium, student loan payments weren't due for 4 years, and the labor market was very tight and skewed toward lower paying jobs, right? Because it was the retail and the restaurant job, the high contact jobs during the pandemic where we were seeing the highest pay raises. What we've seen over the last few years is kind of getting back to normal, which is that the folks at the lower end of the income scale are seeing slower wage gains than the folks at the top. And as always, they're not benefiting as much from higher asset prices.
Just quickly, where have you got inflation at the end of the year?
Still in the high twos. I think it probably accelerates early in the year as more of the tariff-related price pressures get pushed through and then maybe comes off a little bit as we move toward the end of the year. I think by the end of the year, the run rate will be 2.5, maybe even a slight bit lower than that, but still above target.
Stephen, good to see you. Stephen Stanley there of Santander with a call for no interest rate cuts for 2026. Key part of that call, though, on better economic growth, and that's what we want to see. This came from the National Economic Council Director, Kevin Hassett. What is the plan in Davos, Switzerland at the World Economic Forum? What will they unveil? What will they tell us about what they can do to address what they call an affordability issue? This comes from Kevin Hassett. We're going to allow people to take money out of their 401ks and use that for a down payment on a property purchase.
They did say they were going to talk about housing, so I guess this is one of the details. On top of the president directing the FHFA to buy more than $200 billion worth of mortgage-backed securities, besides telling institutional investors they need to stay out of the housing market, now, if you are looking to get on the housing ladder, I guess you could take out of your 401k plans. That is going to be incredibly interesting. And I think he says we're still talking about the mechanics of it. So I think we just need a lot more details on that one.
Look out for those details next week, potentially. If you're just joining us, welcome. Equities are still positive, just rolling over a touch. We're up by 1/10% on the S&P 500. With an update on stories worldwide with your Bloomberg Brief. Back with us, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. State Street shares falling in the pre-market. The bank reporting fourth quarter earnings that beat estimates across the board, though. Total assets under management also topping expectations. Investors focusing on news that the asset manager sees expenses rising 3 to 4% in the year ahead. JP Morgan CEO Jamie Dimon saying there's absolutely positively no chance he would take the Fed chair job. Speaking to Carlyle's David Rubenstein, Dimon said he would take the call if considered for U.S. Treasury Secretary. Dimon also expressed concerns that chipping away at Fed independence could lead to higher inflation and interest rates over time. Federal prosecutors charging 26 people in an international sports betting scheme. The case involves 17 Division I schools and the Chinese Basketball Association. According to prosecutors, more than 29 games were rigged, with investigators saying fixers bribed dozens of players, generating millions of dollars in illegal wagers over 3 seasons. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for this morning. Up next, we'll set you up for the day and the week ahead. Plus, we'll catch up with Mona Mahajan of Edward Jones, with investors gearing up for another big week of earnings and a major speech from the president in Davos, Switzerland.
Last year, as we talked about, was all about AI and technology. This year, we think it's a story about broadening. We think that there is a cyclical recovery in the cards. We see that because we think labor markets will continue to stabilize and improve. You have easy monetary policy and tailwinds from fiscal policy. And I think that sets you up for a broadening of the growth story.
That was Stephen Parker of JP Morgan Private Banker a little bit earlier this morning. Welcome to the program. The opening bell about 42 minutes away. Equities positive by 0.15% on the S&P, up by 0.5 on the Nasdaq. What a run for the Russell for the start of the year, higher by 8% so far in 2026, up this morning by 0.1%. What a week we've got coming up for you. So this is what the trading diary looks like. Today, lots of Fed speak. You'll hear from Bowman, Jefferson, Collins. Then we get the quiet period. No Fed speak until the next decision at the end of the month. On Monday, markets close stateside for Martin Luther King Day. Elsewhere, the World Economic Forum kicking off. Tuesday, Supreme Court opinions, results from United Airlines and Netflix. Plus, President Trump's self-imposed credit card cap deadline. Wednesday, another chance for a SCOTUS ruling on tariffs. Plus, the president speaking in Davos on Thursday. Jobless claims and results from Intel. That's quite a week just around the corner.
Pick your poison and what you want to focus on next week. For me, obviously, going to be the president's address as well as the self-imposed January 20th deadline. There's no law, so I don't really understand what the deadline is. But this coming from Kevin Hassett, we're going to allow people to take money out of their 401ks and use them for a down payment. The president will put the final plan out in Davos next week. This could have tremendous amount of implications, not just for the housing market, but what you were pointing to earlier, for equities.
Let's get into it. Let's turn to the stock market. Mona Mahajan of Edward Jones writing, we believe US corporate earnings are on pace to achieve double-digit growth this year. We remain overweight equities relative to fixed income. Mona, welcome to the program. This is slightly unfair because those headlines only just crossed, so you're going to have to do this with me in real time. And if you don't want to go there, don't go there. But what on earth would happen if everyone started tapping their 401ks to buy houses? What would happen to the stock market?
Yeah, look, we'll have to wait for details from the president next week. But certainly, I think the motivation here is to make sure that all households, whether you're in the upper income bracket, mid-income or lower income, have exposure to a diverse set of asset classes. And I do think fundamentally that theory and consideration is the right one. We want to make sure that all households are thinking about investments from an early stage of their career, their family development, their home ownership development. So broadly speaking, we think if this starts a conversation of how should I position my assets, whether it's in equities, fixed income, or real estate, it's a good step in the right direction.
Well, let's start with where this is coming from. So there is an affordability problem, has been for a long time. This administration inherited it. Now they need to address it. The remedies to that affordability crisis, how do you think that's going to shape market outcomes in the year to come?
Yeah, there's different ways the administration can force this or do this. If it's using blunt instruments like putting caps on credit card interest rates, that will have adverse outcomes for the broader economy and then certainly the players in that sector. Now, if you do this in a way that is, let us do this in a gradual way, let us take an approach that offers you, whether it's tax relief, whether it's deferred tax payments, whether it's thinking about opportunities at lower rates depending on your income level, I think doing it in a graduated fashion makes more sense than trying to use the blunt instrument approach. But I think overall, the affordability issue needs to be addressed. And certainly as we are approaching a midterm election year, makes sense that we're starting to think about this early on.
If you want to start thinking about affordability, the midterm election year, what do you want to be exposed to in the equity market?
Yeah, and I think your earlier guest alluded to this as well. We do think that this is a year where diversification does matter. And I think, we've come off of 3 years where AI and technology have really dominated leadership in the markets. If you did not have exposure to those themes, you really were underperforming. Now, this year, we think if you have exposure to both the AI parts of the market, but you have some exposure to cyclical parts of the market, value parts of the market, international and EM, and by the way, have a little bit of fixed income exposure, that is the way that your portfolio is going to perform. And I think the combination of a steady economic growth picture, a Fed that is likely going to cut on the margin, but also earnings growth that is accelerating this year supports that broadening theme.
When you say the Fed cutting on the margin, one cut, is that what you're expecting for in 2026?
So, our base case is 1 to 2 cuts in 2026. We think they're probably towards the tail end of this rate cutting cycle, but nonetheless, we do think the Fed is looking to get towards a neutral level. And typically, if you look historically, that neutral level is usually somewhere around 100 basis points above inflation. So if you think inflation ends around, or it kind of steadies out around 2.5%, a Fed funds rate around 3.5% to us makes a lot of sense as a base case.
Since we're on the Federal Reserve, this week really kicked off with Chairman Powell coming out quite publicly and pushing back against the administration. That story's got old very, very quickly. Mona, do you see that as noise or news?
Yeah, I think it was initially quite a bit of shocking news to hear that the Federal Reserve Chair was under criminal investigation. But to your point, since then, we've seen not only Fed Chair Jerome Powell come out strongly, but old former Fed chairs, as well as congressional members from both sides of the aisle, supporting this idea that the Fed independence is important. And what we've always said is, if the market gets a sense that Fed independence is being questioned or challenged, not only can you see market volatility, you'll probably see rates rise, especially on the long end, as that risk premium gets baked in. And that's squarely opposite of what this administration wants, which is lower rates. So there's a little bit of a counterintuitive cycle happening there. But I think generally markets have made it clear that Fed independence is important. And that's probably the direction of travel.
And the good news is it's preserved and yields have barely moved all week. Mona, thank you. And world-class punt on the 401k question, by the way. Thank you very much. Mona Mahajan of Edward Jones. Everyone needs to figure this out in the week ahead.
Yeah, of course you want to punt that. They're waiting on potential details. I mean, actually, is this legal? A lot of employers match some 401ks. This has a lot of work to do. But also, you have to think about, what does this mean long term? If you are able to tap your 401k, you're likely potentially going to get a more expensive home. What's going to happen when all these people start to retire? Are they going to actually have the funds to retire? Right?
Set the stage. It's kind of the perfect backdrop. The World Economic Forum, a room full of global elites, and the president going after every sector under the planet about affordability. Isn't that the perfect backdrop for this speech next Wednesday?
Yes. Also because many people were saying maybe he won't go to Davos because they want to see that he's, hanging out and at cocktail parties, which I doubt he'll be going to. He doesn't drink. But, hobnobbing with the world's global elites. Nope. He's going there to talk about a message, how he thinks the World Economic Forum is off track in what they focus on. And he wants to bring it back to the everyday concerns of Americans and probably a lot of people in other countries as well.
Compare the approach to this week to the approach to last week. Last year was about an administration that was going to come in and deliver a positive growth shock. It was going to do all these fantastic, favourable things that would be amazing for economic growth. 12 months later, and we've got the president going into Davos, Switzerland, potentially going after everybody about affordability and pushing back on things like compensation and capital returns.
And dividends and stock buybacks. Also, the fact that he's going into the World Economic Forum with someone that individuals from the C-suite would find terrible for their growth perspectives. I'm talking about he's going in with ideas that come from the far left, like Bernie Sanders and Elizabeth Warren and Zoran Mamdani.
It's going to be quite a week coming up, so the lineup is shaping up. Some of the highlights of the World Economic Forum on Bloomberg Surveillance include the Morgan Stanley CEO, Ted Pick, the Bank of America CEO, Brian Moynihan, will catch up with the Energy Secretary, Chris Wright, and the Commerce Secretary, Howard Lutnick, and a whole lot more. Looking forward to spending next week with you. Have a wonderful long weekend stateside from New York City. This is Bloomberg.